and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Can we get much higher? It's Thursday, June 26th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Thomas Westwater in Chicago, taking you through the rest of this trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform on tastylive.com, welcome. Thank you for joining us. Come over to YouTube. Tell us what you think of this action, this listless melt up in markets, low volumes, low volatility to find the day. The S&P 500 doesn't clear 1 million contracts traded. No, sir, or ma'am, whoever's listening. But we do see a push here in the triple Qs and NDX, two fresh all-time highs. NASDAQ futures barely a few hundred points away. The S&P hits a fresh June high as well. We see here now it's at its highest level since that February 21st PMI growth scare, Ilya. As you make your way around the market, bonds, they are trading up, and they get a little bit of a kick in the pants today, treasuries across the curve, when the Senate parliamentarian comes out and says, you can't cut Medicaid the way that you want to. So maybe the one big, beautiful bill, as they're calling it, it's not going to move forward in this deficit form and fashion that we thought. Okay, gold's not so strong, but silver and copper explode to the upside. Oil has a strong day too here, so maybe there's a growth flavor to this market today. Currency is bad for the dollar, which admittedly I'm out of any long dollar positions now in the euro as a result of this. But we have a lot to discuss. We have new highs here coming around the corner. We have ridiculous headlines for sentiment checks, least of which, of course, our resident bear has abandoned his bearish positions. Ilya, apparently, where I sent you the snippet earlier. We're using the blockchain to design shoes in space now. Okay, Ilya, what do we make of this, though? Volume is low. Volatility is absent. It's an 11.5 IVR on the chart right now. What's doing here?
It's very tough to fight a market like this, and I stopped 2 days ago. When we breached the swing high from earlier in June, that U.S. CPI data high, I picked up and left at that point. I mean, obviously, I've been taking on the short side with very small positions, very risk defined, only verticals and only in the ETFs to keep things nice and small and keep risk very, very, very constrained. But even so, you're not going to argue with the price action here. And when we, certainly I'm not, when you took out that high on the closing basis there, you can see it in the chart, that gray box is at that high, and then you clear that, and so I hung it up right there. I don't think anything has changed for me from a macro perspective, but as ever, if you're right at the wrong time, you're wrong. So I'm not going to sit here and continue to have capital get tied up here. Obviously, these moves don't scream conviction because there's so little volume behind them. We're heading into the July 4th holiday. We've got the July 9th cliffhanger on tariffs that apparently the president says doesn't matter. There's another one shortly thereafter in mid-August. That's the cliffhanger with China. That one probably could matter. But all of those but qualifications don't put any money back into your account if you're short and the price is going up. So I'm not going to fight this thing. I've backed up. My song remains the same, much as it was in the second half of last year. We are operating in a global economy that is dangerously near recession because it has one and only one point of failure. In fact, we're about to get PMI data out of China next week that tell us Europe and China are at standstill, much as they've been over the past 12 months. The only growth that there is U.S. growth. It is a level step down from where it was in the second half of last year, but it is positive. And as long as that doesn't fail, fingers crossed, apparently the markets are okay with pretty much anything. And helpfully, the Fed hasn't started cutting rates, and maybe there's a degree of narrative here saying, well, they've still got all the cutting to do. So if only the economy were to take a step in the wrong direction, here they come. They want to be cutting. They'll ride to the rescue. Markets, incidentally, think that they're crazy for not cutting already. In fact, you're seeing the dovish divergence in markets building out here, as we've talked about yesterday, Thomas. So I think we're in a situation where I have not been disabused of any of my bearish thinking in sort of macro terms, but in practical terms, I'm hands off until the market tells me it's time.
Thomas, stocks are continuing to run up higher here. When you and I were speaking earlier today, you said that you weren't into chasing at these levels. Why don't you think this is a good idea to latch on and ride the bull wave right now?
Yeah, I mean, I was thinking about getting a position this morning because there's no reason in the market to keep the buying from going, right? The durable goods orders was pretty good. Initial jobless claims didn't send any warning signs. We're focusing on lower rates now, which we saw in the bond market today. Kept predicting that. It was the light volume holding me back. So it's kind of like you said, a melt up. And I just, I feel that itch when I'm trying to go long of maybe I shouldn't do something. So I'm still holding back here. Of course, in retrospect, I mean, getting long yesterday was probably a good thing, of course. But I said if I was looking at something, I was going to take that SMH position. Had a good run in it today, but I just didn't jump on it.
I think that's one of the key features of this market right now. When you look to something like SMH, the rip higher here after a few days of consolidating back at the end of May, or rather the middle of June, excuse me, now running to an all-time high. The sector performance here is really quite strong to quite strong today. Only 3 of the 25 are in the red. Real estate is down by 0.12%. IYR, that's the weakest sector ETF. That's nothing. XLP, consumer staples, that's fine, being a weak one on a day where you have SMH. It's charging higher, up 0.73%. But that's not even the most impressive name on the board. I'm more interested in what's happening with the regional banks here. The regional banks are sitting at multi-week highs now. This chart's a bit of a mess. Let's just make a small adjustment and clean this up. It looks like there's somewhat of a ceiling here, right around 60 in KRE. But regional banks may be breaking their downtrend finally, and the Russell has been lagging for a long time. So if regional banks are up, semis are breaking out to new monthly, new quarterly highs, returning to the highest levels that they've seen since last summer. It's just going to be really difficult for bears to get something going in the short term, right? Ilya, if I'm thinking about this as a bear, my point of interest is not in what's happening today or tomorrow, but in the fact that volatility is getting pushed down across the curve the further you go out in time. And if I wanted to express a bearish point of view, I could do so a little bit more cheaply than I could have otherwise. And it wouldn't be through something like selling a call spread up here, although given how the market is in a low volume, low vol float, you could try to do so if you get the timing right, where if you think it's going to go up like 0.4, 0.5, 0.6% a day, whatever, just go out deep enough. But the play may be to look for some downside protection here. There may be some complacency in this market. Mm-hmm. And before I go into this further, if only to expressly articulate the headline that I shared with you yesterday, and I shared this on Futures Power Hour today, which I don't know if people saw this, but it's worth reading in full for those that aren't the audio. They're visual, excuse me. They're not audio. Let me read this out loud. A footwear startup is teaming up with 2 space companies to design a shoe in orbit as part of a mission to make artificial intelligence and blockchain less expensive and more eco-friendly than it is on Earth. Orbit's Edge, a company that supports AI and blockchain applications, and Copernic Space, which offers digital marketplaces for space assets, plan to send a solar and battery-powered satellite to space equipped with a computer that will use AI automation to produce a shoe design.
They have all the words in there.
Scintilla brand. The mission is expected to launch on a SpaceX Falcon 9 rocket in early 2026. I have no idea what I just said.
I mean, this is
came out of my mouth.
This is the Pets.com Super Bowl ad of stories. I mean, this is the kind of thing you read and you go, wow, remember how Polaroid decided that they needed crypto in their name and their stock actually did bounce no matter how ridiculous of a thing that is? Yeah, there we go. We're designing AI and crypto shoes in space. This is ridiculous, obviously, and is emblematic of the kind of excess of risk appetite that you might be worried about in an environment where this is the year, next year, when you refi all the COVID debt that companies accumulated at basically no interest. The Fed doesn't want to cut rates. The U.S. economy has slowed meaningfully since last year and is the only one that's growing of consequence. Yes, let's design a shoe in space. This is the kind of thing that happens at sentiment tops.
It feels like it, doesn't it?
Yes.
Like Long Island Blockchain Corp.
Can we get an Economist cover? I'd like an Economist cover saying like, la-di-da, all is well. Can we do that? Should I start to do to the managing editor of The Economist what you do to the Ayatollah and just start to troll her on Twitter?
Well, which, by the way, I just have to send out like a heartfelt appreciation. I did get a direct message last night with someone sharing their trolling of the Ayatollah with me over DMs.
It's a community now.
You know, Team America. Okay. We were talking about a potential bearish position in the S&P 500 today on Futures Power Hour. There are really 2 ways to articulate this view. You could, of course, do the out of the money thing where you go to like the 20 delta. We'll look at, say, like long the 25 delta, short the 20 delta. It's about 100 points wide here. It's a 24% probability of profit, high convexity, basically 6-to-1 on the risk to reward. But what Jamal was kicking around here as just an idea is if we go over to a long put spread that's already in the money, and it gives you basically a coin flip probability of profit, even though the max profit to max loss is tilted in your favor, basically 3-2. Volatility is cheap right now is my point, okay? And this market does feel complacent for a variety of reasons. My own outlook here, not that it's been accurate this year, because having just seen the tastylive SPX predictions by quarter, mine was 6,300 for Q1, 6,000 for Q2, 6,300 for Q3, 6,850 or something for Q4. Although, again, I would push back and say at the start of this week, the S&P 500 was at 6,000. So with a week left in the quarter, it was pretty darn close. But I see this as a market that is going to hit that roadblock in August with those China tariffs, right? We have a White House comment today. Carolyn Leavitt, the press secretary, says that the July 9th deadline is not critical. We're not looking to extend it, they also said, but it's also not critical. It's because you can't have a world in which you have lower tariff rates on China than you do on all your allies and friends. It just doesn't make any sense. It's illogical. So July 9th isn't anything, but August 12th is. And looking at some option plays with relatively cheap vol on the other side of August 9th for a brief window of market panic, perhaps, as the summer goes into its second half, when liquidity drains and more experienced traders go on vacation to Ibiza or the Hamptons or the Ozarks, wherever, okay, the junior traders tend to panic. I think that if you're going to be bearish right now, not that I am in particular, because I want to chase this high of being a dumb bull that just buys out of money the calls and watches them print. I missed it so much, Ilya. This needs to be now like risk management, okay? Like, what are we doing to reduce our beta weighted deltas if we're running this market up higher? How can we position so that we're protected from some downside? How can I stay on the bull train with also keeping something in my pocket that if this goes sideways, I at least can get out relatively cleaner? And the cost of that insurance is pretty cheap. So I think this is the primary consideration right now. It's a bull market. We're running to the upside. I'm staying on as long as possible. I want to see 23K print. That's where my long calls are currently situated. But once we start to get up there, looking back to like 22,000, 21,500 at NQ as some safety, I don't think it can hurt us.
It doesn't look like you have a situation here that is going to look for intricate catalysts or kind of high-minded ideas. This thing is either going to hit a sentiment extreme or it isn't. And it's probably going to have to be something very obvious, or, as markets often do, nothing at all, where you just run out of reasons to go higher because everything is in the price and nothing else good is obviously in the speculative window.
Thomas, what's standing in the way of this market? Tomorrow we have PCE. Friday, tomorrow feels like a day to go golfing for most people. End of quarters Monday, non-farm payrolls will next Thursday. Thomas, do you care about the non-farm payrolls report next week? Is this something the market is particularly worried about, in your view?
I do, and I think, volume is going to continue to be light tomorrow. I wouldn't expect it just to bounce back on a Friday. So I think people are going to come back next week. We got the NFP a day early for the holiday, so kind of a condensed trading week. On one hand, there's a lot of people away. On the other hand, it's condensed from 5 into 4 days. So perhaps, we could get normal volumes, or it could continue to be light. But the reason I was waiting to get long is I was waiting for some catalyst when it's really just a confluence of factors that have been holding the market back that have now cleared, right? So like Ilya said, we have to hit a sentiment extreme. And until the NFP, we really don't have anything that could come through where it's going to really unhinge this rally. So On one hand, I want to chase because the price action is telling us, we're going higher. On the other hand, I feel like I'm already a little late. And when I get in when I'm a little late and trying to chase, it's worked against me a few times. So for right now, I'm waiting. But next week, I think I'll have to pick a strategy to play this out for the NFP.
Do you think the Fed cares about next week's NFP, Ilya? I know that we've heard from Bowman, from Waller, and now today from San Francisco Fed President Mary Daly, that a rate cut may be appropriate and will be something that's discussed in July. She thinks that September is still going to be when the Fed cuts. She says in the fall. Okay, so I guess September, or was it an October 30th meeting this year? It's late October again. Whatever the timing of the cadence is, it seems like her mind is that they're getting a cut in the fall in September, but July is not going to be a meeting where they don't even entertain it. So does non-farm payrolls, could non-farm payrolls next week let me rephrase this a different way. Isn't the best outcome for bulls right now for non-farm payrolls not to matter next week? Because if it does matter, it means that the July needs to think about a July cut.
Well, so there's a couple threads at work here. First off, the markets think that the odds of a July cut are more meaningful than policymakers seem to have hinted. So we're looking at a 20.1% chance of a cut in July. That's not nothing. And it's certainly up a meaningful ways from 12.5% a week ago. And let's note, a week ago was the Fed meeting. So in the immediate aftermath, right, here we are on Thursday. Exactly 1 week ago is the Thursday after the late afternoon FOMC on the 18th on Wednesday. So the markets heard the Fed. They went, right. So you don't want to cut, and you're not sure what to do, and you think you have all the time in the world. Yeah, you're likelier to cut in July. And in that period, since they heard the Fed, they've built out all kinds more easing into 2026. The Fed said 25 basis points in their SEP. The market said, right, sure, 62 basis points.
I mean, we've added basically 40-ish basis points to the rate cuts by the end of next year in just the past 3 weeks.
Yeah.
We've almost added 2 cuts to next year's calendar in 3 weeks.
So the market, so there you go. The markets they're not just saying that, oh, you're behind the ball. They're saying, no, it's happening. And frankly, you're likely to move both sooner and later in a much more dovish way than you're suggesting. So will the markets care about NFP? Well, it probably depends on what the number gives us, but NFP has been so muddy with the revisions that unless the number is completely unmistakable, it's very difficult to hang your hat on what comes out, and you really have to focus on the jobless rate and whether you finally get north of 4.2%. Thomas was mentioning earlier, jobless claims, not terrible today, but looking at the 4-week average, this past reading is a bit of a step down, but it's within a hair of last week's result, which was a 2-year high. So it's not like the labor market isn't deteriorating. The average NFP revision so far, the running 12-month average, is down almost 17,000 on a given month. In the latest numbers, the 2-month revision was 58,000, lower 48,000 before that, and on it goes. These numbers have been routinely revised weaker And the average for the 2-month revision has been negative going all the way back to January 2023. So let's see what these numbers give us. Last time, the expectation was 130. La-di-da. We got 139. So only a touch better with a 58K downside revision on the preceding 2 months. Was it a good report? You tell me. It was a little bit better at the headline and much worse for overall job creation. So it's a curious thing that we're looking at here, but the markets clearly seem much more interested in what they think. Bonds are rising, dollar is getting smacked, more expectations for rate cuts are entering than what policymakers are saying. I don't think the markets care very deeply here about what the Fed is saying. I think the biggest risk for markets is if NFP is really strong and it turns out they're the ones that are offsides. The best case may be actually a relatively soggy number as long as it's not catastrophe bad, where the Fed might be shown to be very, very behind the ball. But that seems very unlikely just by the nature of kind of the spread of probabilities. A really out there tail risk result is inherently unlikely. So you're looking at probably something middling, and the markets would like something softer. Because if they get softer, they get validated. The Fed looks like it's wrong, and then maybe July really is live. Or at the very least, maybe the Fed says all the things that they need to say. So that by the time we get primed for Jackson Hole, there's a big fancy Powell speech that sets everybody up, and in September, maybe we go big again. And maybe it turns out that we get a 50 basis point cut again because the
I've been saying that
we should have gone in July, baby. What were we doing? So
that's the funniest outcome. Like last year was Powell declaring inflation being dead. That's what 50 basis point meant, right?
Yeah.
Trump didn't like it because it was a sign before the election that the big story before the election was over, and obviously it wasn't. But that's how it was spun. So 50 basis points in September here, how would that be spun? Would that be...
We should have got in July.
We should have got in July, and the economy is probably weaker. So but if the data holds up, right, Thomas, isn't this kind of like the dream scenario that you're seeing for bulls here in terms of rate cut pricing? All of the fears, the bricks in the wall of worry, they haven't materialized. And so the market's like, well, they're going to materialize, so we're going to need more cuts in the future. But in the meantime, the market's like, well, we're discounting cheaper money at least. And so we can party until the damage comes. It's not that the market really loves the Fed cuts, needs them, but like, hey, we have more easing coming down the pipeline. Who cares? We can run this thing up.
Yeah, it's something to underpin the market, to underpin sentiment. So, I mean, the initial jobless claims wasn't bad, but if you look at the continuing jobless claims, those were the highest since late 2021.
Yeah.
So it's kind of a good scenario if you want more cutting, because it's saying that companies, they're laying off, but they're doing it at a very steady rate, and they're not hiring that much. So people are getting forced out of the job market. It's taking them longer to find jobs. So that's not a catastrophe. So if the numbers come in slightly weaker, those July rate cut odds all of a sudden go from perhaps 20 to up to 40, 50. And then the market is hanging its hat on getting a July rate cut and then a September rate cut. But yeah, you're right. If the September comes in 50, of course, a 50 says we made a mistake somewhere, because otherwise it's going to be a 25 like they've been projecting. So I agree with Ilya. The best case scenario is probably slightly under expectations or at expectations.
We turn to the halfway mark of the show. We've been talking about equities here. Bonds had a pretty good day too, guys. It's after hours, technically, or after the market is marked to close. But we see that ZB here is now at 115 and 2 ticks. It's currently sitting at the highest level that we've seen since the start of May when it bumped up into here. It's been a level where the market's been struggling to break through in recent months. Ilya, it feels like if you're going to be a bond bull, you kind of have everything, going for you. Oil prices have come off, so the inflation scare is gone. And also, oil being too high is disruptive to growth. So,
that's right.
Right, at least we have that intact. We turn around and think about what's going on with the Fed. They're not cutting in the short term, despite a lot of pressure to do so. And two things I think actually, two ideas that we've shared here on Overtime in recent weeks. One, a Fed that's refusing to cut will help the bond market stabilize and move up because it's not reflationary. Bonds are up 4 or 5 points over the course of that idea. It's been slow and hasn't been great. Like it's not moving fast, but it's working. And the other one was that equity traders would be forced to chase this market through the end of the quarter because of positioning at the start of April, because everyone just being off sides, people continuing to short the market on the way up. And then that's, of course, underpinned by the rationale. You can't lose money in a bull market. If someone's giving you money to trade for them and you underperform SPY, you're not justifying your job. So
it's not that you can't. You can. You're just not allowed to.
Right. Well, so bonds, though, are kind of, Tuesday you said if the bond trade's going to work, it's going to work slowly because bonds shouldn't move quickly.
You want it to work slowly.
Why is that? Can you just reiterate?
You don't want bonds to be doing crazy things. You don't want for the markets to be having volatile opinions about the long-term faith and credit of the world's largest economy. We saw what that looked like in April. Those are not happy times. You do not want, if you're any kind of optimist about anything, frankly, because the treasury bond really is sort of the underpinning of the global economy, as is the U.S. dollar. This is the cash choice of commerce when it comes to the dollar. It's the benchmark risk-free asset for global finance writ large when it's the U.S. Treasury bond. So you don't want for there to be chaos here. And sure enough, no chaos. We're just slowly crawling higher. And I've been long the long end for a while. That's the part of my portfolio that is helping to paper over some of my sins elsewhere. Most recently, I extended duration about 10 days ago. I've still got 50 days in these TLT call spreads that I have on. So I've given myself lots and lots of duration. In fact, that's been my MO basically since the beginning of the year, to stay small with more duration than usual, to kind of dilute my exposure to directional delta and really take time with these markets because they're very choppy. The only place I haven't done that is in FX, where I've just been outright trading the micro futures and spot. And frankly, that's been my bread and butter all year. So looking at the bonds here, they're doing the thing you want them to do. If you're bullish, what you want is an orderly, steady stair step. That's exactly what you've been seeing since basically the second half of May. On we go.
Thomas, you have any strong feelings on rates right now? Notes are trading at their highest level since the start of May. We can look at this from the yield perspective. 10-year yield is now down to 4.239%. That's good news.
Yeah, I got long a call spread in ZN. I still have to get that on the follow page for the 57 days out. So I gave myself plenty of time at the 112.5, 113. But yeah, like Ilya said, nice and steady. This is definitely a bull market that we're in for the trend right now. With the time I gave myself, I'm willing to weather any pullbacks. And, pretty much what I'd expect to see if we pull back is something to like the 21-day EMA 111.075, maybe somewhere around there, which you have, one of your support resistance lines right there pretty much. So that's kind of what I'm thinking. I didn't want to wait for a pullback to get in here just because the time I have is, I feel fine with that. But I think, the view now is rates are going to come down. It would take something pretty big to throw off the calculus for where rates are going. And if that's going to happen, you'd see a lot of dysfunction elsewhere in the market too. So I just want to get some long exposure here. That's my only position in bonds for now.
I think I might make an adjustment to my directionally neutral positioning in notes over the coming days, if only because we're starting to get away from the midpoints of the trading range. I say I might because I still have fairly decent strikes to make this work. Given the volatility when this trade was put on, I was able to sell the guts basically at the extremes for the year, 109, 114, right? I still have that correct here. 109, 113, and buy back at 108, 114. So unless we go down to the low in February or to the high here from the start of April in the next 7 trading days, which I guess is possible, but I think that directionally neutral continues to work. The only question that I find myself asking these days, it's a 16.4 IVR. I guess that's richer than what we're seeing in ES or in Q, but there's just not a lot of vol in bonds. And I know that when vol gets this low in notes and bonds, people tend to look elsewhere. What's the trade here, though, Ilya, for the next few months? I think you and I were on board with the chop, and the chop hasn't stopped. Mm-hmm. But is the chop still the play if we have to start having conversations about, wouldn't it be funny if the Fed had a cut by 50 basis points because things are so crappy and they're running so far behind? Is that a good thing for the bond market?
I mean, I'm perfectly happy to stay long as this continues to kind of begrudgingly work. And if the Fed throws us a little bit of a bone here with a level change in rates, yeah, okay, if you front load a bunch of cuts, then maybe you get to a place where inside of a 2-year window, you get fewer cuts downwind because the Fed has finally jumped. You kind of saw this with what happened with the 50 basis point cut in September last year, right? The markets were yelling at the Fed from mid-April until that mid-September cut. You have to cut. You have to cut. You're going to miss the boat. You're going to miss the boat. You got to go. You got to go. And the Fed was resisting and resisting and resisting. And all through that resistance, bonds were rallying. The dollar was getting clobbered across the board because the market were saying, okay, so you're not going. That means you have to do more later. It'll be more dovish. It'll be more dovish. Then when the Fed finally goes and they go 100 basis points this year, 50 up front, 2 more meetings left. You do the math when those rate cuts are coming. We're locked in. And market goes, whoa, hold on now. That's a little bearish. That's not what we said. This is a little too extreme. You've overshot. And then bonds sell off and the dollar rallies into the end of the year. So if the Fed does 50 basis points in September, the big question will be, do the markets think that's too much? Mm. What does it look like in relative terms? Right now, the Fed is baking in 50 basis points for the year. So unless that calculus changes, and I suppose we'll have to watch what they do in July and definitely watch what they say at Jackson Hole, because that'll be a kind of lens framing exercise. Then we'll see. Last year, it was very clear. The Fed came out at Jackson Hole. They gave the tip of the hat in the dovish direction, and then there they go in September. If this year they reframe the lens again at Jackson Hole and it's dovish, we'll see. Because right now, the markets are basically in line with what the Fed forecast is, at least for this year. It's 50 basis points. So, and frankly, a little bit north of that today. It's starting to creep. It's approaching 60. So we'll see. We'll see where the market is set after Jackson Hole, when it's time to go in September. But if the market judges that a 50 basis point cut is appropriate, and they seem to be angling that way here, the ongoing disappointments in U.S. economic data over the past month, today's durable goods jump, and it was a big jump, notwithstanding, the overall sort of vibe in U.S. economic data has been generally negative for about a month. This would give you a sense that if the market thinks that 50 basis points is right, bonds keep going higher. It's contextual. It's not automatic.
Well, that puts the dollar in an odd position here, guys. I know the sentiment's cooked, and I just took off a position today. I tried to short the euro, and it had a nice few days.
I've been taking them off since the beginning of the week. This is not working.
It seems normal to me because it's okay. Sure, all of this wasn't normal when we were going through the whole tariff nonsense. But since we reset the table, the dollar has basically been following the bond market. Lower yields, weaker dollar. Lower yields, weaker dollar, right? And so I don't know if we can call that a surprise. Technically, this thick white line here is your 50 SMA. We hit it in February. We hit it here again in May. We fail up against it earlier this week. That engulfing bar brought us back down below the 1 month and the 1 week as well. So the bearish momentum is clearly here still. Although I took a small loss in the euro position, again, it was put in place with enough duration so that if we breached 117, be able to get out at a small loss, and it was like $275. We go over to 6J, and this is where I am now starting to try to lay out capital to get short the yen. This is still a currency that has a 2.93 Z-score in terms of speculative positioning over the past 20 years. It is outrageously crowded right now. And we've seen it more crowded at the start of April and May. But never before in its history has it been this long. Okay, if you were to compare positioning in the market today to literally any other period of time prior to the start of 2025, that would be the highest, biggest net long position you've seen in the yen. Period, end of story. So I want to fade this. I don't want to be involved in a long yen trade at the moment. I want to be involved in a short yen trade. So right now, I'm going to put this back on if it doesn't get filled. I'm trying to start to buy into the 68-67 put spread with 71 days to expiration, basically looking for a return down towards these range lows that we saw in April, here in May, and again, just a few days ago in June. The yen to me is cooked. It doesn't have a reason to be up here. We got the bounce that I was looking for. I wanted that bounce earlier this week. We mentioned get up to like 0070 and we could start to look bearish again. It happened today. So I'm going to poke around on long dollar in a very narrow sense because of a crowded market.
Yeah, I mean, I thought that we were starting to get a little bit crazy here in the dollar, and I actually flipped over my shorts into small long exposure Friday last week, thinking, okay, we've probably hit something here. There's a key technical level. The risk reward is good. The trade is terribly crowded. Let me take a step back. Let's turn these cards over. The Fed doesn't want to cut. They've just said so loudly. We had Powell testimony this week where he wasn't going to say anything different, and he didn't. And it hasn't worked. Probably the most dramatic places I'm looking at isn't the yen. The yen has been kind of consolidating in what's increasingly a kind of triangle-looking something. But just look at the euro. Look at the pound. They are scorching. And
yeah, that uptrend the pound was breaking a few weeks ago. It's technically back above it now.
That's the thing. So it started to maybe crack, which is what got me short, And no. That's not what's going on here. Even the Canadian dollar found a little life here against all odds. But I mean, look at the euro as your kind of benchmark for the most liquid U.S. dollar counterpart. I mean, the dollar index is essentially just the euro upside down. This is unmistakable. This is every opportunity for a double top and then a clear,
Never happened.
just very, very, very obvious first page of a technical analysis textbook bullish breakout. Like obvious resistance, test, hot knife through butter.
Well, I mean, that was the risk outline when we took the trade, right? It could be an ascending
That's right.
triangle still.
That's right.
But I guess, Thomas, given the positioning that we know, where people are far too long the yen and the sentiment on the dollar is still very bearish, would you take multiple cracks at trying to get long the dollar here, even if you have a few trades that miss out? Do you find the risk to reward appealing enough?
Well, last week I got out of my short put spread on the yen, pretty much at the bottom, and then I got into a short call spread on the euro, and so I've been burnt on both sides now. So I'm surprised the dollar's gone this low. So one of the reasons I got that trade on the yen is because you told me last week the positioning was so extreme, and I agree that that kind of trade can't last.
So we're saying blame Chris.
It's your fault.
I like it.
Yeah.
Well, okay.
We're saying blame Chris. Good.
Yes.
I'm on board with
That's
this.
fair. I'll wear that.
Yeah, and then last week I tried to sell the call spread on the euro for this double top, and of course that hasn't worked out either after being long the euro all year. So I think, the underlying reason is the dollar's weakened so much. I'm wondering for the euro, are growth expectations lagging what the market thinks for Europe right now with the defense spending and everything else? Is it going to be a story of Europe has better than expected economic growth over the next few years? Are we starting to price that in now? Are people trying to get ahead of that? Or is it just the dollar is, continues to weaken for, it surprised me how much it's weakened. So, it's calling, do you try to call a bottom now? And I'm not going to do that after two bad trades within the last week.
Sure.
So right now I'm going to stay, I'm going to keep my euro position on right now and hope for a pullback to take that off at either, at unsure, a small loss. But I'm going to step back and reassess the currency market with not being able to really see what the dollar is doing here.
Ilya, one thing that's really important to me is showing signs of personal growth. I don't often do it, but a year ago, you and I were trying to get long the yen because of positioning. Everyone and their mother was short the yen.
Yeah.
And it felt like every 45 in, 21 day out, I would buy some yen calls, and then I'd watch them evaporate into nothing.
Oh, we got cooked.
Well, it's very generous of you to throw yourself into the pot with me, because
I was long the yen for similar reasons, although in fairness, I didn't stick around as long.
But July comes around, and I say, I've been doing this for 6 months. Maybe the positioning argument isn't going to hold up, but of course, positioning is like a glacier. It takes time. It just doesn't happen. People don't just liquidate everything all at once. And so I stopped buying the yen. And then last July, the yen decided to do, what did the yen do last July? Oh yeah, it did this. It went straight vertical after pushing on that string. It was going down, buying calls, just like 100 pips out of the money every time.
I managed to catch a little bit of
you
it
caught
on the second leg of it.
That's why I'm saying, like, don't throw yourself in the pot with me. And the point I'm getting at is that there was a macro, a positioning, a not a short-term view that was worked out. Like this is going to break at some point. I just need to stay solvent before the market snaps to being rational. And I could have been. And I just got tired of losing little bits of money. And had I just stayed with that, okay, this positioning is going to break at some point. I just have to be patient here, and I'll catch a wave. I was right. I just fumbled the ball. And so it feels like this is the same thing, but on the other end right now for the yen, where we have this extreme positioning. It's sitting around being short the yen. You've been getting chopped up. You've been getting eaten up for the past 6 weeks, 2 months, right? You haven't been able to get that downside traction. And I just can't throw in the towel this time because I need to show that personal growth where I understand that if it's a good idea, I just need to stay solvent long enough and stay small enough so when it does hit, I don't, if I'm wrong, I don't get wiped out. And I didn't last year. I just got bored. That's not a good excuse. That's not staying mechanical. It's not staying within the confines of the trade idea. Thomas, I understand why you're not going to call a bottom here. But a year ago to this day, I was on Overtime complaining to Ilya that I was sick and tired of trying to be long the yen, and then it spit in my face immediately the week after. I just can't do that to myself again. Mentally, it's not going to be good for my mental health. Okay, I'd rather actually lose
Michael
money.
Burry in 2007. You're not wrong, but you're early.
Maybe I'm early. Maybe that's it.
This is the perpetual thing that I'm always talking about when I am entering these tiny little pinprick shorts against the stock market that I don't believe in. It's because if the market is telling you something, sorry, technically it had already fallen by the time I left. Technically. When I take these little stabs, it's because the price action has created some kind of risk-reward opportunity that's attractive. And maybe it's right and maybe it's wrong, but I'm going to structure it in a way where it's asymmetric enough that if I lose a little, and I'm okay losing a little multiple times. If the idea seems legit, if the price action tells you it's go time, it's why I didn't stick around in the yen as long as you did and then got back in. I was waiting for the price action to show me. And I'll take little stabs like that, and I'm okay with losing on quite a few of them, as long as 1 or 2 really pay. And that's sort of the thing you have to do, I think, if you're going to take a macro perspective on markets, because timing macro stuff is a fool's errand. You never know. So if you have some kind of macro narrative and you think it's right and you see evidence to suggest it, when the price action lets you, take a stab. You're probably going to be wrong a few times.
I always go back to the baseball analogy. If you're scalping, you're a slap hitter. You're just trying to get little singles all the time. If you're a macro trader, you're the slugger, right? Like you're going to strike out a lot, but you're going to hit the home run every now and again. And like it has the net expected value is positive. Like you want the guy who strikes out a ton and hits dingers, because it's good for your lineup construction. You can't just have a guy who hits 300 and only gets singles. You're not going to get anyone around the bases. Thomas, I wanted to ask you a question here before we end the show, because energy is back in focus. We called this out a few days ago after oil had its big 10% decline. Ilya, you and I were talking about exiting short deltas, flipping to directionally neutral, understanding that previous sell-offs of this nature, when you have 10% or more over the course of 2 days, you usually get a window where there's a little bit of a bounce back over the next day to week. Next day was historically right around 2%, the next week a little bit around 4%. So the fact that oil has stopped falling, so to speak, I don't think surprises anyone in this room. Thomas, you mentioned to me earlier today that you're surprised natural gas has fallen as far as it has. You and I both, I think, are in similarly structured trades where we've been selling put spreads down against like the 3.3, 3.4 level. How are you feeling about this now, given you've had a full day to digest the price action and really what's been a week of fairly aggressive selling in natural gas?
Yeah, I was feeling worse this morning, but we trimmed a lot of losses. So the EIA numbers came out today. I think it was a 99 billion cubic feet build. The 5-year average is right around 78 for this time of year. So we're building more than expected, and we've done that for a couple weeks. So I'm still keeping my short put spread on at 3.25, 3.3, and I think that aligns with some technical levels that are buy points in the market. And kind of right today we saw buying when we got down near 3.4. You saw the buying start. So I'm going to stay in it. I was thinking about taking my the call spread side off because I have a short call spread on as well for 32 days out. So I'm going to take that off in the next couple days here because we're starting to run out of time. I'll leave the put spread on until around 24 days. So I'll wait until next week to take that off. And I'm expecting, of course, that 3.4 level. That's all I'm looking for to hold. If we drop below 3.4, I'll take that short put spread off and reassess. If the 3.4 breaks 3.2, 3.0, we could drop under there because there's some room that we haven't traded at for quite a while. So 3.4 is kind of like the line in the sand right now. It's been really hot the past week. The U.S. has been in a heat wave.
Has it?
That should have, you know more than anyone. That should have, reduced the stocks more than expected. But at the same time, you had wind and you had solar displacing a lot of natural gas demand. So it was sunny and windy everywhere that it was warm last week. So you kind of got a canceling out of that, the expected effect that you would see in natural gas, which is really, really hot, a lot of demand, strong inventory, or a less strong inventory build during the summer. That didn't happen. But the buying today at 3.4 is kind of encouraging. After 4 or 5 days of selling, I think if you want to get long here, I'm already long on that side. I wouldn't mind at all.
Yeah, come help us. Come help me and Thomas.
I got out of my oil short yesterday, and that's the only thing I'm doing in energy right here. This is one of the more confounding spaces. I'm not eager to jump in one way or another.
Well, with that, overtime is out of time. We'll be back in a little bit. Ilya's coming up next with Macro Money, so stick around after the break. I'll be back later today for the Price of Truth with Victor Jones, so see you in about an hour's time. Until then, though, for Thomas Westwater and Ilya Spivak, I've been Chris Vecchio. See you on the other side of a break. You're watching Tasty Live. Ilya Spivak with Macro Money up next.
See you there, everybody.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Craig in New York City, what's up?
I just want to say, I've been with you since the very early days of Thinkorswim, and traded all kinds of markets here and there. And I got to say, I could be off so much worse if it wasn't for what you guys have sort of drilled into me over years and years and years. And so I just want to thank you, because you could have easily just taken the money and run when you sold Thinkorswim, and you didn't, and you started this. And you basically have just given me this full education in this thing that was completely foreign to me many, many years ago. And so even though I've lost money in the last few days, you've saved me a lot at the end of things. Like, losses could have been catastrophic, and they're not. Cool. So I appreciate you.
I hear you.
I appreciate you guys. Thanks so much.
Thank you, man. And I appreciate you holding on the line to say that to us. So thank you.
I'm like the Tupac of economists. going out on top. And will I ever really be gone? Say bye to Ben Bernanke. Cry your eyes out past the hanky. Gone from the Fed, but still looks swanky. Bye-bye, Chairman Ben Bernanke. Ben Bernanke, hardly knew ya. Ben Bernanke, glad we're through ya. Sayonara, Mr. Yankee. Closing bell tolls for Ben Bernanke. Now, say hello to Janet Yellen. New blood, maybe start some selling? All around the world like a market Magellan. Hello, Janet Yellen. Janet Yellen, Professor Shady. Janet Yellen, new chair lady. Welcome in the new Miss Yellen. Different from the old, there's no telling. And I'm out, like Tupac, in a peaceful transition.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades Today. I'm Tony the Bat Batiste, and I've got not one, but two trade ideas for you today.
Exploring zero DTE. We promised you we would take a look, and here we go.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Well, the markets continue to melt up, and it seems like they're doing so for no particularly good reason or with particularly strong volume. Nothing especially shocking on the calendar. No big new headlines from Geopolitics or from the world of economics, at least over the past 24 hours. Nothing to really suggest that we ought to be screaming higher or not. But nevertheless, the markets take their cue, and we're approaching the year-to-date highs on the major stock indexes. The U.S. dollar is lower across the board, and the markets still seem to be building out expectations that the Fed is going to end up much more dovish than expected, even most importantly by the Fed officials themselves. So what is the backdrop for all of this, and can we sustain it? That's what we're going to task ourselves with trying to understand today on Macro Money. I'm Ilias Spivak, head of Global Macro here at Tasty Live, and we get the opportunity to get a check-in on the overall global economy here as we prepare for a update on Chinese performance early next week. We have earlier this week seen the June PMI data set for the US and the Eurozone and many of the other major economies, China is always about a week late. And next week, we begin to see what they have for us for June and start to put together a more complete picture of the global growth environment. So that's exactly what we're going to do here. Look at what this data might give us and consider how it might impact the overall backdrop. Now, of course, that isn't to say that we are going to get a direct read-through from this data into the price action. It'll depend if the price action decides that it wants to care. But as ever, it is a game of relative value here and a game of watching and seeing whether assets make sense in their valuation relative to the back story and not just in isolation. So this will be a backstory shaping set of numbers and a back story shaping kind of a conversation where we'll try to figure out if the global economy really is in as good a shape as these buoyant financial markets seem to suggest. So let's begin here with what is expected. These are going to be the official PMI numbers from China. As with the U.S., there's two sets. In the U.S., we have the kind of global standard, the PMI numbers from S&P Global, and we have the Institute of Supply Management that creates a parallel survey. They pull a different set of businesses, but produce a similar thing. In China, it's somewhat similar, where you have the official numbers here from the China Federation of Logistics and Purchasing, CFLP. That's in conjunction with the National Bureau of Statistics. This is the government's PMI survey. It's tilted more so to large enterprises and state-owned enterprises, or SOEs. There's a parallel set, which we'll take a look at in just a second. That's from S&P Global in conjunction with Caixin. So we'll compare them and see what the story is. The picture here for China in these numbers clearly seems to be of ongoing standstill. So this was the reopening pop here when China finally jettisoned its zero COVID policies and reopened the economy. We can see there was a bit of a surge here. Manufacturing never really got off the ground in a meaningful way, but certainly letting people out from lockdowns was a boon for services. And so there was this services surge right here that lifted the overall economy. Since we're going to be talking about these PMIs a lot, let's just, for the uninitiated, very quickly explain how these numbers work. This is a diffusion index. And so the way that this is constructed is it's tracking the services and manufacturing sector's activity growth and the pace of that growth. 50 is neutral. That is neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the pace of growth. The further you go below 50, the faster the pace of contraction. And so clearly here we can see, following on from the manufacturing and service sector lines here, the story is of anemic manufacturing for quite some time, but then you get that pop at the reopening in services that fizzles relatively quickly, and you settle into this multi-year standstill where you now have a situation, looking at these forecasts again, where you're hugging that 50 line. So basically going back to mid-2023 and through to now, China's economy is going virtually nowhere. Here's a composite reading from that rival survey, the Caixin and S&P Global survey. And here you see it's been a little bit zestier a year back than were the official numbers, a little bit higher on these readings. But as you work your way through the past 12 months, the story is increasingly negative and increasingly converging on what the official numbers are showing, so much so that the May number was actually worse than the official figures and gave us a slip underneath 50. And when you look at the composite internals, these are those Caixin services and manufacturing numbers. You can see services, since that pop in early 2023, they've flatlined, much as the official numbers would suggest. Saw that right here. But we can see that it's really manufacturing falling off a cliff in at least these numbers in May that really gave us that very disappointing overall reading. And so when we consider then what comes next, we sort of see both of these things pointing in this kind of stagnant direction. Now, this is not entirely new or unusual given recent months, and really sort of echoes, this is why we look at PMI numbers, incidentally, it echoes in the most sort of hard data you might imagine, GDP statistics. And this is, of course, the story now for 8 consecutive quarters, speaking to the issues in the world's second largest economy. Here's that pop at the open of 2023. Since then, we can see the economy has done virtually nothing. The pace has held relatively steady and dependably sub 3% for growth, which by China's standards, we can see here, the pre-COVID levels are meaningfully stronger. But looking at what we're seeing here, the biggest issue really is that when you compare nominal and real GDP, you find that real GDP for the past 8 quarters has been growing faster than nominal. And this is the spread. You can see that when you take the difference between nominal and real GDP, you get a negative number now. Whereas you can clearly see before that, the norm was substantially pointed in the opposite direction. So when you had Chinese growth here, and it was in real terms hovering just above 6%, you're now at very similar levels here, albeit you're hovering a little bit under 6%, but the makeup of the growth is vastly different. And what this speaks to, because of course, what is nominal GDP? It is the sum of the value of all the goods and services in a country, and it doesn't factor out the impact of inflation. When you add up these things, these are sort of nominal prices without being discounted for the prices themselves going up. And so oftentimes you can get an overstated version of demand, for example, here in nominal numbers because of inflation. So you take inflation out to get a real sense of growth. Now, if real growth, that is nominal minus inflation, is running above nominal itself, then you're discounting nominal by a negative number. And that's what you're seeing here. Economy-wide deflation for 8 consecutive quarters. Now, this is, of course, horrible news for any economy, because what it essentially suggests is vast overcapacity relative to demand. So lots and lots and lots of of supply, much more than demand is able to absorb. And so the entire economy is essentially on discount. The price of things is getting marked down and in economy-wide terms falling, essentially the price of GDP falling, because there's not demand to absorb all of that. And essentially what you get is an economy that for basically 2 years here has operated without demand growth. So needless to say, what we're seeing in the PMIs very much anticipates this state of affairs continuing going forward. And indeed, some of the higher frequency data we've seen recently are a case in point. At the top here, we have the latest inflation data. We can see the PPI index dependably below zero, showing us that wholesale inflation has been falling, going all the way back to COVID lockdown days here, mid-2022-ish into the second half of the year. We flip from positive to negative and stay there. Headline consumer prices hugging zero and have been hugging zero potentially since early 2023. The story on the external sector, hardly encouraging. There's been a little bit more pep on the export side, arguably around the front running of tariffs and U.S. demand being especially robust here at the start of the year as we get that rebuild of inventories that we saw with such sharp relief in first quarter U.S. GDP numbers. But domestic demand going the opposite direction. And that's not a happy thing when you consider that you've had anemic manufacturing for quite a while here. A short pop is not especially helpful. What you really need is for the service sector to come back to life, for domestic demand to start to take up some of this slack. And these fading import numbers, they don't suggest that that's the direction that we're heading. In fact, this is looking increasingly negative here. And the pop in exports, in fact, over the past 2 months, seems to be fading, where the front running is running its course and we're starting to recede back. There's still a very significant pool of capital out from China. We can see here foreign direct investment still negative to the tune of double digits, but of course it has improved significantly from being worse than a 30% drop there by mid-2024. Capital is still coming out of China in droves, but the pace has, of course, improved and was eventually going to improve even just in statistical terms as you adjust year-on-year calculations for basing them from lower levels. So eventually this pace was going to normalize, and frankly that we're in 8 consecutive quarters and of deflation, and we're only normalized to a decline of worse than 10% year on year in the latest data, still quite discouraging. Where you do see a slight sliver of positivity is in whether China's raft of stimulus measures might finally be showing a little bit of life. So we can see here, this is the Bloomberg Credit Impulse Index for China. It measures the share of new loans in GDP. Of course, China has been attempting to lay out oodles of new money to try to incentivize demand. They've cut bank reserve ratios. They've cut economy-wide interest rates. They've announced all kinds of schemes for debt relief from municipalities, for giving money to consumers for all kinds of various things, be they lower mortgage rates or incentives to buy stock or incentives to trade in old appliances for new ones at very lucrative terms. All kinds of cheap money designed to get the economy to finally start to show some life. And now that we see for the past 2 months a slight sliver of positive year-on-year growth in this index, we get the sense that, okay, maybe finally new loans are starting to perk up. Problem is that people don't seem to be wanting to spend the money. This is a view that we've been looking at here for quite a while. This is the difference between China's value of demand deposits, that is to say, those things that are there to be used almost as a checking account, so something that's earmarked for consumption now, and the difference between that and time deposits. That is to say, those things that are looking at savings, CD equivalents, and things like this for the overall economy. And so you look here, and what you see is a very significant disparity that seems to be opening up here. And the disparity really continues to grow and grow and grow here. And for the overall kind of level here, this is as high as the data available goes back. So what is this telling us? Well, maybe, in fact, yes, there are more new loans at these more lucrative terms. Maybe people are finally starting to believe somewhat that this money is really and truly available. But what they're not doing is spending it. What they're doing is increasingly sticking it in here, in savings. And so that's how you get fading imports. That's how you get still an economy that doesn't want to do much of anything growth-wise. Because it seems like consumers are not confident that growth will come back. They're not confident that the right things are being done by officials in Beijing to really kickstart this thing. They're just stuffing money under the proverbial mattress. They're taking all of this new money and they're sticking it in savings. They're not going out and spending it. And that suggests that, yes, maybe we have a little bit of hope for stimulus starting to work a bit because there's uptake of these new loans. But if the money doesn't get spent, well, we know all about that in the U.S., where we had tremendous easing in the wake of the global financial crisis, and then consumers used the money to rebuild their balance sheets and didn't spend it. And so the recovery was very, very sluggish and prolonged from the recession in 08-09 until we started to see some green shoots a little bit going into 2014, 2015, 2016. This is not dissimilar in the sense that, yes, there is cheap money. Yes, people are taking the cheap money, but they're not doing anything with it that might generate growth. The problem, of course, is that China is the second largest of the main engines of global economic output, along with the US and the Eurozone, and the story continues to be imbalanced, where the US is the only one holding up the entire situation, not just because of its share, but because of the way that it's performed. Consider also that the 42% in the rest of world part of the pie here are mainly vendor economies that depend on buying from the large three in order to have demand of their own. Here were the numbers from the Eurozone this week. Standstill, hugging 50. As we can see, this is not unusual. They've been averaging just a hair above 50 for the past 12 months. That, of course, is in contrast with the U.S. numbers, which are a level step lower from the very buoyant 3-year highs on growth that we saw last year, but more positive. And when we compare that with the overall picture, we can very clearly see where the imbalance lies. All of the second half of last year, it was China and the Eurozone at standstill, and the U.S. powering ahead. The wedge has narrowed, but nevertheless, it is still the same story. Standstill in China, standstill in the Eurozone, and more modest but still positive growth in the U.S. That would be all well and good, except as we look at the way that U.S. economic data is increasingly performing relative to forecasts, we can see that of the major economic engines and groupings here, it is clearly the U.S. where data is underperforming, today's buoyant durable goods data notwithstanding. Emerging markets, relatively steady. Eurozone actually improving. The overall global economic data surprise index fading, suggesting that global data flow is cooling. That's clearly coming from the G10 space, of which the Eurozone is not the issue. Clearly, it is the U.S. that's pulling the situation lower. And so, for the global economy as a whole, we are left with an ominous backstory. This is the only part that's working, and it's also the one that's deteriorating. This is already at standstill, and this will probably remain so when we get this PMI update next week. Now, will the markets care, and will they start to turn to a more risk-off direction on this basis? As ever, we'll have to watch the price action to see. But if something does occur to spook investors, the backdrop is certainly anything but cheery. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I'll be back with Chris for Futures Power Hour tomorrow. We'll also be covering for Tom and Tony on Last Call, so you'll see a bunch of us as a special case this week. I'm likewise on The Price of Truth with Victor Jones on Tuesdays, with him and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
Forbes called us best online.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, $4 grand. which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
All right, Julia. All right, Nick. All right, Mike. All right, Jamal. All right, Glenn. What was the last trade that you made?
Oh, it was bad.
Oh, man.
I bought SQQQ. It's like a 3x inverse ETF. I feel like I get shit on for the inverse ETF trades. They're not, I wouldn't say they're always good trades, but I'm like, I kind of don't want to get in the options right now, but I want some leverage.
I got long some Apple, and it just happened to work out in the last about 5 minutes here. So I sold a wide put spread out in May, and it basically lost half of its value in the last 5 minutes.
My last trade was closing out a meta calendar spread that was worthless prior to the 500-point rip in the E-minis.
Last trade I placed was I closed out.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Got a lot going on this week. Market's still ripping to higher highs, so we got some things to talk about. Before we do that, Gus, how we doing, bro?
Doing well, hanging in. Yeah, we just keep gradually eking towards these all-time highs, just like you said. I mentioned on Tuesday that there was a lot of similarities to the COVID recovery going on right now, and I think that certainly still holds true. I actually have some interesting numbers in that front to bring up in a little bit. But yeah, feeling good. I'm still very long Delta, and so I continue to make good money when the market goes up. So I'm happy we can spy to 700. Let's do it. Why not?
Yeah. Hey, I mean, it seems like risk is easing a little bit more. I know tensions have been easing with the Iran and Israel war and those type of things. So, I mean, the market seems like it's feeling good so far, but things still feel eerie to me. Like sometimes we'll get consolidation, we'll get some aggressive pullbacks. It starts to feel a little eerie, but we're ripping all-time highs. I don't know. It's difficult to trade these levels, but at the same time, I'm like, is something brewing here? I feel like with Israel, Iran, and just other geopolitical things going on right now, I just wouldn't be surprised if we got any type of headlines that catch us off guard and are surprising, especially when everything feels good right now because we're at all-time highs. So that's been running through my mind.
It's funny, and that's one of the things that's been crossing my mind with the COVID recovery comparison as well, because as we were, coming out of that COVID dip in mid 2020 and approaching all-time highs, it seemed so logical that we would maybe get those all-time highs again, touch them, and then consolidate for a little while and chill out, because there was still so many reasons for there to be volatility and so much uncertainty and so much fear still happening in the world. But it just that fear and uncertainty that was present in the world did not, show up in the market. The market was not reflective of it at all. The market acted like there was no fear and we were in a greed phase. And so I think, that we could be seeing something similar to that here, where even though all of the external and, news-driven things that we would usually pay attention to are screaming that this shouldn't be happening, we just keep pushing higher. And, I become more of a buyer of this theory every passing day.
No, I hear you completely. We're very familiar with this all-time high talks. I feel like we put in so many over the last few years, especially. But I mean, VIX has been really quiet, but Dr. Jim made a really good point yesterday. Even though the market's been rallying to the upside and it's a little down on the day again because we've been putting in new levels to the upside today, honestly, it's not as low as VIX could be. Like earlier in the year from last year, we were trading at lower levels on VIX than now, and we're putting in all-time highs. So maybe we're still due for a little bit of a pop in VIX, but hopefully that pop's not just to like 18 and then back down. But we haven't gotten a pop in VIX in some time either, and we're still trading at all-time highs. So another point there.
Yeah, Dr. Data and the wonderful research team shot over something this morning that showed that put buy volume is 19% higher than call buy volume right now, which I do think is something interesting. Perhaps something brewing there. Efficient market hypothesis suggesting things are going to move down, but it creates this. I don't know. It creates a very interesting and nuanced situation with the VIX. I feel like because if we there's all this pressure coming in. I don't know. I think you hit the nail on the head saying that VIX is absolutely not as low as it could be. VIX is not, telling us the story that we are, absolutely through this and just cruising and chilling now. There is still more downside room there and some indication that we could possibly, see some volatility in the coming weeks.
Yeah, 100%. We'll see what we get. I mean, we'll dive into the platform here. I got on a few extra positions this week. in line with a lot of this volatility at the highs that we've been getting. I don't know if you've been having any thoughts on crypto, but I did get some exposure over there. Crypto's been ripping all-time highs. Not as much crypto talk as I would have thought there would have been with crypto at these levels. But Bitcoin is not playing any games either. Gus, I don't know if you've been keeping an eye on crypto, but it's been booming. No doubt. It's been booming.
Yeah, that it has. There's lots of, this is just such a pro crypto administration. We just have one, regulation stripped off after the other, it seems, and we're getting it to be a lot more of a free market, and it allows for a lot of different things. Something that I saw the other day is that the name of the company is escaping me, but somebody is offering tokenized shares of SpaceX now, because that's something that's doable under these new regulations. So
tokenized shares at SpaceX. Okay.
Yes, because SpaceX is not a publicly traded company. I don't know enough about the crypto and blockchain space to really dive into the weeds of it, but they're offering tokenized shares of SpaceX. There is an avenue now to get some actual equity, or at least synthetic equity of SpaceX going on, which I think is interesting. And crypto presents all kinds of opportunities in that regard. And events contracts also are popping off right now.
We can't just brush over that. That's a pretty big deal. I mean, I feel like that would even be a pretty big deal for other private companies in terms of letting shareholders within people that believe in the company and are help build it get access to that without being public and going public. Like, especially SpaceX being a leader in general in terms of innovation. I'm curious to see some of the logistics on that end that they apply with some of this. What was the term that you used again?
Tokenized.
Tokenized, right? Tokenized private equity, or like tokenized, not private equity, tokenized shares. So I'd be curious to see if that ends up being successful and if other companies end up doing that, because I mean, I've never heard of something like that before.
Yeah, it creates all kinds of interesting opportunities with being able to buy into whatever private company you want. I mean, you could sit here, like Chick-fil-A, for instance. What if we could do tokenized shares of Chick-fil-A? I'd be a buyer, There's all sorts of avenues.
Yeah, no, 100%. We got Beto here. Not moving too much relative to where the overall market's been with Ethereum and Bitcoin, but I did get on a few new positions this week, especially after ripping to all-time highs. I wish I would have put on some of those positions today, but we got on some Netflix. It's been a little while since we traded Netflix, but I ended up selling an out-of-the-money call spread. It was pretty close to the money. The market ripping earlier on today, touching those, and now we're sitting in the money. But Netflix has been going on an absolute tear to the upside. Because I don't know if you have any thoughts on Netflix, but Netflix is not playing games. That's a sleeper build this year.
Yeah, absolutely a sleeper build, and something that I can remember being a magnificent stock just 5 short years ago that has since been replaced by other contemporaries in the market. But it just continues to rip. Netflix is making all kinds of moves that I've been fond of. I think that their expansion into live sports and the things that they're trying to do with pay-per-view and boxing are very interesting, new forays for them, and I think that could be a very promising future moving forward, especially as they try to capture more market share in the NFL, which is something they've been pushing for. I believe they have the NFL Christmas Day games coming up again this year. I think that's the contract they have, but. Yeah, I think that Netflix, this traditional streaming service, which has really never wavered from that business model, like the way that Hulu has. Hulu moved into live TV some years ago. I think it's very wise of them to be making this move into live TV. They just keep on ripping. It's crazy, and it's insane to think that this mail order DVD company from 20 years ago is suddenly now going to become a major live sports provider.
I mean, we can learn so much from the run that Netflix has been having. I mean, I don't know what that would be in basketball terms, but I mean, Netflix is having, I'm not going to say a 97, 98 Jordan Bulls run, but I mean, Netflix, the way they've been adapting and pivoting over each decade has been phenomenal. I mean, we can only say that in hindsight as time goes on, but I mean, we grew up with Netflix. We grew up, going online, emailing or mailing those discs to your door. You go to the catalog online, you do that. And then also Netflix destroying Redbox. I thought Redbox was going to be the next thing. Redbox outside of all your grocery stores, convenience stores, very convenient, to be picking up and dropping off those movies. That was very short-lived. Netflix has stood the test of time. So, I mean, my initial thought was, man, how well are they going to be doing diving into live TV? Like, can they really, and given their history, given their track record, I'm not going to bet against Netflix here, even though I'm still curious how they're going to maintain that industry for the live TV.
Absolutely. I think that they've shown, for decades now that their greatest strength is their ability to adapt. They've never been afraid to, take a gamble and try to make sure that they get ahead of the curve. And they also really understand the value that convenience has to consumers. And I think that's something that two things that have, really, really propelled Netflix for this long. And I think will continue to propel them into the future. They seem to be in good hands.
Blockbuster. I thought we retired that word. Good old Blockbuster. Man, I mean, Blockbuster is one of those guys. Blockbuster is the what could have been of D Rose.
Yeah,
like
and they passed on Netflix, man. They laughed Netflix out of the room.
I mean, I don't know what happened. I mean, D Rose could have been was one of the youngest MVPs in the league. And I mean, Blockbuster had it in their hands, and I mean, they fumbled the bag, So I still don't know how that happened, how slow it is to adapt. I don't know. I know it's not easy, especially when you're a bigger company, to adapt and kind of shift gears. But at the same time, I'm like, man, I would have sold the company to Netflix or another streaming service, because Blockbuster, I mean, the kids nowadays probably don't even know what a Blockbuster is, you ask them. So time's been flying. Other than Netflix, we got a little bit of coin, was getting some exposure to the crypto market, especially with all the volatility we've been getting. That one's been running against me a little bit more today. Sold an out of the money call spread. These ones were shorter duration. These ones were 22 days till expiration, 23 at the time that I put them on. The market's still rallying to the upside. So we're going to try and manage that one. They are smaller position size and they're defined risk. So we're going to give those some time to cook. Disney's been another one that's been running against me to the upside. Disney's been another one that just hasn't been moving as much as I thought the other underlyings would be running. And I mean, it put in a pretty decent day today. Before today, we've been trading in a pretty significant range. Other than that, again, I bought this option, so that time is cooking against me. That's the only one that I did buy within all the positions that we have on right now. And then next after Disney, we have Circle Internet Group. This was another one that we got on yesterday.
You found a trade here, man. I've been looking for a trade on this like all week. I haven't been able to find it. I'm
you haven't been able
here.
to poke in there? Yeah, and we're up a little bit on it today. So we're building ourselves a little bit of a cushion. I had to go 50 days out to get the premium that I wanted on this one. Did end up selling an out of the money put spread, $5 wide, collected about 215. 238, I'm sorry. So I collected almost half the width of the strikes. I'm comfortable with that. Sitting out of the money right now. IB rank is pretty solid. Volume is there. Markets aren't too wide. I mean, it's pretty solid. This thing was going on an absolute tear to the upside. Maybe we catch a little bit of a bounce here. So it looks like we could still have some more room to the downside on Circle Internet Group, though. This one has caught a lot of momentum over the last few days. And I happened to catch the initial bounce on the way down. So I'm comfortable there. If we make new lows, we make new lows. But we have some cushion. After that,
I was looking for some downside on that, and Disney as well. Actually, I'm happy I haven't in regards to Disney. But yeah, when Circle was getting up near 300, I was looking for any way I could get short and sell some premium without deploying like $10,000 of capital, which is what it was looking like it was going to take. And I just couldn't quite figure it out. I looked at some spreads, but the liquidity was just weird, and it was hard to fill orders there for a second when it was really going parabolic earlier this week. So I never got involved, but I am jealous of this position.
No, I hear you. I hear you on that too. I did have to squeeze into this position a little bit more. I didn't get filled where I originally wanted to get filled as. So I slipped my way through there, was able to collect a little bit more credit on the spread. So I was okay giving a little premium there when we put this trade through. Give it some time, see how we work out. Again, if the market continues to sell off, because I mean, let's go to the daily. Let's get a larger time frame perspective.
Yes, and Theta Trader, great point. This is absolutely the meme stock issue. I assume that you, Theta Trader, know more about selling premium than anybody else, given the name. So I trust your judgment on this.
Circle Internet, bouncing today, but at the same time could have some more room to the downside. So we'll manage as we need to. We had QQQ. We ended up getting long yesterday at all-time highs, which was really difficult to do. I don't know if anybody else has a difficult time trading in the direction of the trend, but especially after we get a very extended move. But we ended up pulling the trigger on that. We put that one through yesterday. The market rallied even more today, so that ended up paying itself a little bit. But what I also did was, because we ended up rallying to the upside, I ended up selling a call spread against that QQQ position at the same time. So hopefully we don't rally too high off these all-time highs. So ended up legging into that iron condor.
Yeah, you're really putting yourself into a box there. Huh?
I know. I had to. Look. I could barely last 24 days with going with the trend. I had to leg into the other side less than 24 hours later.
Bro's just itching to be contrarian.
I know. I'm glad we got a little bit of a pop before we did that, though. So maybe I can finagle my way back out of that. Maybe I can leg back out, but we'll see what we can get. Lulu, this one traded really well, was pretty liquid, especially for earnings not too long ago. Was able to capitalize on that one. So we're back for Lulu round 2. We ended up selling an out of the money put spread on Lulu. Collected about $391. This one was $10 wide, a little bit wider. Almost 40% of the credit or 40% of the width received on that one. So comfortable there, sitting break even there. Not too much going on the last 24 hours in that position. But that's what we got going on in the portfolio. I don't know if anything else stands out to you, but I think Lulu's going to be on the mind for the rest of the week at least.
I know Coinbase. I know I get 2 Coinbase scam text messages a day, so maybe.
Really? Is that from?
I don't know if the market is pricing this in, but the scammers
leaking
are hunting
insider
our Coinbase
information
accounts.
right now. This man leaking real-time information. No, I mean Coin put in another massive day today. Coin started to go ballistic June 17th, consolidated 2 days after that. We had another leg up. We tried to pause yesterday. That's where I sold the out of the money call spread. And then we had another leg up today. We rallied to another high. So it's extremely bullish. It's a little bit more volatile than these other crypto assets, it's looking like. So, I mean, Coin is definitely in play if you want some volatility. Look over in Coin.
Yeah. If you want some volatility,
go Coin. If you want some volatility. Oh yeah,
you guys. By the way, I have to circle back and acknowledge the Magnum PI commentary earlier. This is making me laugh. I'll throw on the loud Hawaiian shirt and the aviator sometimes, guys, and really get the whole flow going. And Theta Trader, in response to you, I don't have a red Corvette, but you don't know how long my shorts are right now. They could be uncomfortably short. Also, Mike, great pull with the beige wall. I've actually sold that house now, so the beige wall belongs to somebody else. But. Yeah, Coinbase, this is interesting. Coinbase, there's a lot of these crypto companies or crypto adjacent companies, and I've said this about MicroStrategy a lot, where I don't understand why you would ever buy it instead of just buying the cryptocurrency directly. Coinbase absolutely does not fall into that boat. I think that all of this regulation is really a rising tide raises all boats sort of situation with Coinbase, and that it will trigger more people to trade crypto. And as they go out to look for places to trade it, Coinbase will be one of them. So I can understand it. Nike, I was surprised by this move, and I'll tell you what, I was really close to getting a short.
Just do it, Gus. Just do it, brother. Come on.
Just you saying do it now?
I said, just do it. You should have done it.
That's do
the slogan
it.
Now.
Yeah, you're right. I should not. Yeah. Well, I was going to get short into earnings, which would have burned the shit out of me. Now I'm a bit more, I don't know. I'm a bit more, I want to get short still, is what I'm trying to say. I would love to
it looks better to get short now.
Definitely better to get short now, right. But I don't know. It's all kind of weird. I love to trade the post-earnings moves, especially if they're as exaggerated as this one has been. But I don't know. Something's putting me off with Nike. I think maybe we're still too oversold in general, and Nike especially is just so beaten down over the last year. It's hard to imagine they could make lower lows, and that was the thought process that eventually put me off of getting short into this earnings call. But yeah, I think I'm just going to leave it alone.
Yeah, no, 100%. We'll take a quick look at the volatility index here. Was there any other new positions that caught your mind this week that you ended up putting on there?
Yeah, let's have a look.
Vol's getting crushed right now. Bro, we really never got that pop.
I've added some long Novo Nordisk. Looks like it's going to pan out. They just took a gap down earlier this week on some bad Wegovy news. Felt like that was an over-exaggerated move, so picked up some long there. And that's really kind of the extent of new things that I've put on this week. I have a very much losing position on General Mills. Thought we were going to get more upside action on that than we did. But Yeah, that's pretty much it. I still got my the ones I believe in that I've been harping on for a long time. I got my Bath and Body Works, my Rivian, my Starbucks still all hang around. Match.com, I have a very winning position on Match.com that I've had open for some time. But yeah, kind of just, I don't know. I've been hesitant this week because even though I just said I'm seeing all these similarities with the COVID recovery and how I think we absolutely could make higher highs, there is just still a lot of uncertainty with how long I already am already. I don't really want to get any longer, but I'm also not fully convinced we're going to hit all-time highs and make any downside at all. So I've kind of just been sitting on my hands and looking to make exits this week, and I'll figure out how to restructure once I have some capital right back in.
Hey, well, hopefully we have some capital soon because, I mean, look at SPY. SPY's creeping up. Man, this just looks like a March 2020 recovery, but on crack. That's what this move looks like right here.
What I alluded to earlier is that it was recently brought to my attention that both the crash that we had this year and the March 2020 crash both started on February 19th and both lasted 53 days until and this one is pushing. This would be the 54th day, but mid 50s days until we return to all-time highs. So it really is incredibly identical recovery that we're seeing here. This V-shaped recovery. And go ahead.
March 2020.
Tell me what's funny here.
I mean, I guess it's to whoever's ears it falls on if it's funny or not. No, but I mean, the last administration, we had the same administration. We had the same type of V-shaped recovery in the same administration.
Yeah, the same administration. You have the same. And Trump was doing all the same things in his first term as well to kind of create volatility and shake things up.
So you're telling me.
It's these identical vibes where it's like, surely we can't go higher with all of this craziness going on, and we just continue to chug higher and higher. Nothing stopping the momentum just yet. So yeah, I mean, who's to say we don't just push through to 650 or something crazy before we get any sustained pullback? It's nuts.
No, make me laugh, funny man. That's funny.
I'm just saying, man. None of these things can be ruled out.
No, but I mean, same administration. Things are a little different this time around. I mean, last time the market started running after rates were so low, rates definitely aren't near where they were, back in March. So, yeah, I mean, things are a little bit different here, but, it is kind of interesting. Same exact administration. That means we had the playbook the whole time. Hey, it's too late now. If you're reading this now, it's too late. Shout out to Drake. But if now that we're scraping towards all-time highs, I mean, it just looks almost exactly in hindsight towards the March 2020 crash. And after you recognize it, it's like most of the run has already been done or has already been put in. So all-time highs looks like it's right around the corner on SPY at least. Right now we're sitting at 611.87. And I think the last high that we had was over here February 20th. Near that February 18th mark that you just brought up a couple minutes ago. February 19th. February 19th was last time we were trading at these levels. 613.
Yeah, which is pretty crazy to think that that's only just over 4 months ago, and all of the craziness that has happened in the last 4 months.
Flew,
and we're just about
though.
to be back at a scratch.
Yeah, I mean these 4 months flew. I mean, even again, early April, whenever we were bottoming in the market, it doesn't feel like it was that long ago. Sometimes we can wait so long for the market to pull back.
That was 45 days ago.
I mean, that was one cycle that we trade sometimes. So I mean, almost identical to the March of 2020. Again, back in March of 2020, we recovered so quickly. I was telling myself, there's no way this is lasting. We're pulling back. 5 years later, here we are. So hey, I hope you're still not holding on to that. Believe. No, we're trading Lulu, not Delulu, Gus.
I trade on vibes. Thank you.
I trade on vibes.
As we've established, vibes are an effective strategy for trading.
I mean, apparently. I mean, honestly, that's a valid take in 2025 from what we've seen. I was on social media the other day again. Somebody was like really driving home the point to somebody else as to the fact the economy is doing super well because the market's up. I was like, bro, that's like one of the first kind of like things we learn about the market kind of is that the market is not a direct reflection of the economy. And I just thought that was interesting too, because I'm on social media and like they're like driving this point home to this person in this comment section. And I'm just like, that's interesting.
Yeah, I mean, that's literally like economics 101.
Like
that the economy prices in past and present information, and the market does all it can to price in future information. It's just two different things. Anybody who's taken any college econ class has seen the double helix graph of the stock market and the economy.
Pretty much. Pretty much. Before we hop off here, let's just quickly take a quick look at how some of our
I'd love
Mag
to
7s
shit on
looking.
Apple real quick. Let's do it.
Oh, absolutely.
Stupid
He's
stock.
just a hater. Look, whenever the market doesn't move anywhere, Apple tends to bring along some haters. So, but I mean, I'm in the same boat. Stupid stock. What are we doing? We haven't been doing anything over here lately, but it's been quiet on the Apple side. Real quick, trading Apple, or you don't really like Apple again? I know we touched on this last Tuesday. What was the reason being for that?
Apple has just been boring me in the short term. The stagnation, if you want a broader take, Apple has been stagnant for some time. It's been a long time since Apple has really done like some huge innovative thing in the world. But
Okay, so you're talking stagnant underlying wise and business innovative.
Yes,
Okay.
micro and macro context. Micro context, last 3 months, this stagnation has been annoying me. I think it's especially pronounced right now because the rest of the market is returning to all-time highs. And look at this chart. Apple is nowhere close to all-time highs. And then, yeah, in a more macro context, Apple, we're really stagnating hard here. It feels like in the early 2000s and in the 2010s, every 2 or 3 years, Apple was doing something that really shook up the entire electronics market. I mean, like even down to like AirPods or things like that.
I mean, what else can you do though?
I don't know.
I mean, what else can
I've
you
never
do? You're
known.
Steve Jobs.
That's their job. They're the ones with the creativity and the imaginations that blow me away. I can't.
I mean,
blow
that's
myself
true.
Away.
I mean,
if
as
I could, I'd start a company.
I mean, great point. But I mean, as a consumer, what would you like to see in the space? I do know one of my biggest gripes about Apple back in the day was I'm not like, this phone is way too tiny. Maybe if one day in the future they had a larger one, then maybe. Look, I am now an Apple consumer. They will get my money in some fashion every single year. And I used to say that. Is there anything in the horizon that Apple could do that sparks your interest as a consumer?
I mean, I think, and they are working on the integration of AI, improvement of Siri. Holy cow, that's low-hanging fruit that has been low-hanging fruit for some time.
They could have taken Siri away and I would have forgot about it. Yeah.
For real, I never use Siri because why would I ever? Siri needs a tune-up, and they are working on that. And then I think greater expansion into VR and AR is smart for them. I don't know if the Vision Pro was necessarily the best avenue, or maybe the price point was just too high relative to the rest of the market. But I do feel that Apple certainly has the power and the design prowess to really shake up that world and make a device unlike anything we've ever seen. But the problem with the Vision Pro is that it was just kind of clunky, especially relative to what was available. I mean, you had to have the big battery pack. The whole thing was just a larger apparatus than a Meta Quest. Meta is kind of winning that race right now. And I do think that will, as we've discussed before, I think as Meta starts to take that tech, put it into their smart glasses, that will be something that's integrated into everybody's day-to-day life, and that Apple is missing the boat there.
Yeah, no, I mean, when it comes down to the Vision Pro, I think that Apple had more of the intention or idea, just my own speculation of just kind of like, it was like a test. It was like a beta, the way that I saw it. Number one, the price point, and
it's weird that they gave up on it that quick too. Apple never just. Yeah.
Right.
Yeah.
They don't. So I think it was more of like, okay, this is like $3,500. Most people at this price point would purchase one of our top line MacBooks or computers. So it's like for somebody to purchase this instead of all of these things, that might signal they might not need these things, or they might have already have these things, or they just have the disposable income to drop the extra $3,500 on something like a Vision Pro. So I think they targeted a very specific demographic, individuals that have a lot of disposable income. And I think it almost seemed like they just wanted some feedback. It's almost like they just wanted to test the waters for it, because I am kind of surprised. I didn't think they would kind of give up on that product so soon, but maybe they have more talks behind the scenes that we don't know about. But it's gotten really quiet about the Vision Pro. Nobody's talking about it. It was going viral for like the first month. But
well, yeah, I think I know we're kind of at time here, but I think that it's like the same issue that Google ran into with Google Glass when they tried to roll that out in 2010 or 2013 or whatever that was, where it was just this kind of clunky, overpriced, over-engineered thing that only wound up falling into the hands of the most diehard fans and tech bros, and never actually really made it to the everyday consumer. And so, yeah, I think a different rollout was something that's more accessible to someone like me, because I just straight up was priced out of that market, and I still would be if it came out again tomorrow. Something that's more accessible to an average everyday consumer could really give them a leg up in that space that I think they kind of need right now.
Lastly, how much were those glasses that Google was dropping back in the day?
Google Glass, I think it was like $325 retail maybe in 2013.
$325?
Yeah, which I think is probably comparable price point to a smartphone at that time.
Yeah, I would say comparable price point to the Vision Pro here if you factor in inflation and you carry the one. And no, anything else to add before we hop on out of here today, Gus?
$1,500 is the answer on the Google Glass, by the way. I'm happy I fact checked myself there.
Okay, that's
okay.
We
leave everybody with that.
We factor in inflation, brother, and we're at that $3,500 price point that the Vision Pro is at right now. So
Exactly. So yeah, very, very similar situation.
Yeah, 100%. Anything else to add before we hop on out of here today, Gus?
Nope, that's it. That's all I got.
That's going to wrap it up today. Thanks for taking the time to hang out with us. We'll see what we get for the rest of the week. We will be back next Tuesday at 4:30 o'clock Central Time. Be sure to stay tuned for more segments coming on next, and we'll catch you guys next time. Peace.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on tastylive.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
What's your take on the rally in AI stocks? Do you think it's a bubble? Do you think it's here to stay, or is it somewhere in the middle?
I think it's here to stay. I think it's sort of this century's version of an industrial revolution. It's a new thing. It's creating jobs all over the place, and I think it's going to be around for a while.
Definitely a bubble in some stocks, right? But for overall, no, I'm absolutely bullish AI sector itself. You know, I like Apple, I like Palantir, I like a lot of the semiconductor type stocks, SMH, I like that as well. So no, long term, no, it's not a bullet. It's not a bubble, I don't think.
I mean, I would have said it's dead maybe a month or two ago, and video earnings might be here to stay.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
All right, Mike. All right, Nick. Do you remember the first trade that you ever made in your life or in your career?
I do. It was a long call on Twitter. This is when it was a publicly traded company. It was at like $50 a share. I bought a call at 50, and the next day it rallied, I think, 11%. And it was like the single largest bull rally in one day in Twitter. And I was like, this is the easiest thing I've ever done.
Oh, I know the exact trade. So it was in Costco. I don't know the exact strike, but Costco was trading about 150-ish. This is in 2015. I sold, I believe, the 165 strike call against it because I read some article online that Walmart was going to eat their lunch. Costco, I think, went from 150 to 200 within 3 weeks of that trade. It was a massive, massive losing trade. I learned a lot from that trade.
And you still came back?
I still came back. Yeah. I was not discouraged. I thought I was an idiot, but I was not discouraged.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle. Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Oh, yeah. Tasty Nation, good morning. Oh, yeah, it's Thursday, June 26th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast, a little podcast called The Price of Truth, a show where we like to explore the incentives and much more that govern our world. More on that in just a bit. For now, let's introduce our very special guest on this Thursday evening. Is it? Thursday evening. We pulled the old switcheroo on you guys. We've now got Chris Vecchio with us, the one, the only, the incomparable, the big brain, Mr. Chris Vecchio. Chris, how you doing, man?
I'm doing well. I really appreciated your rendition of Stacy's mom in the green room, but you were talking about Marjorie Taylor Greene, so.
Bro, you grade on a curve. I said she's an attractive lady. She's an attractive, kind of mother. I think she's got a few kids. And I don't get what the problem is. She's got a strong jaw, I'll give you that, but what's the big deal?
I just think, Victor Jones, you're a handsome guy, and you have a beautiful wife. You should shoot higher.
I'm not shooting. She's shooting. She's got a lot of videos out there of her shooting stuff. I'm not shooting at anything. I'm just noting that, if I was going to say, if there was just, let's say it was a binary, okay? We were just doing hot or not, attractive, unattractive, I'd swipe right on MTG, I think.
Still married.
Yeah. And that's a cold open, everybody, somehow. I promise you this is a trading show. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, why not? Go make your life a lot easier and go get both of them. But if you want to be part of Bing, this chat already in the middle of your screen. Jump the gun, you guys. If you want to be part of the chat in the middle, you know my shtick. They're like, we're not playing this game anymore. I'm putting up the chat ASAP. If you want to be part of the chat in the middle of the screen, there's only one way to do it, and that's to go to evil Google YouTube. Subscribe to the Tasty Live YouTube channel and start just streaming your thoughts live in the middle of this stream. Oh, they don't like it. Emmett, Jesus, they got aggressive on that. I don't think they like. I think the chat agrees with you, Christopher.
Oh, good. Okay, it's like, oh God, do I need to pull up the chat?
No, I don't get it, man. You know what I find though? I find men on the internet.
Let's talk about men on the internet. This is a trading show.
You know what blew my mind one day? Oh God, I don't think I'm allowed to say this. I'm going to do it anyway. They blew the day I realized there was like a day when I was like, wait a minute, there's comments under these videos. Those. Gosh. You know what I'm saying? Like there's these videos I've been watching after I reach an adolescent point in my life. I didn't realize that there was a whole comment section under that stuff until maybe like a couple years ago, bro. I was like, you guys are commenting on these videos? There are people talking on these videos.
Do you know who gets into the comments on YouTube and argues with people?
No, I'm not talking about YouTube, my guy.
Oh, no.
I'm not talking about YouTube.
Okay.
You got me?
Oh, God, Victor.
I'm talking about a different type of video. I had no idea until
I was
like
going
2
to say
years
Ilya,
ago.
but now I can't put this on him. Because Ilya
I
does
scrolled down one day. I was like, you guys are talking on these videos? What for? What are you why are you conversing?
You know what?
Come
You
on,
got
Chris.
Me. You got me.
Come on. Come with me, bro. Take the trust fall with me, bro. Don't put up these barriers, my guy. I'm being honest and vulnerable right now. You come into these waters and you take this trust fall with me. When did you realize there was a whole comment section under these videos that there were people actually
sweaty
commenting?
Palms. These are actually sweaty palms.
Say hello to your wife. Say hi, honey. Anyways,
what creatures? What creatures?
So this is my thing. Men on the internet, bro. They talk like their standards are like 9s and 10s only. But you get them in a dive bar with a few Miller Lights, a few Miller High Lifes, bro. They're nothing like what they think they are.
I take 10% probability of profit trades all the time. That's the only way to print those out of the money calls in the NASDAQ. That's where we're going with this, right?
Best analogy.
All-time highs.
That was the best analogy. All right, somehow we're transitioning into markets. Christopher doesn't want to. They're screaming out Omaha in the chat. Omaha. I tried, Chris.
The spirit
You're
of
too
Beth
professional.
lives on. I'm crying. I'm sweating. So I don't know how professional this is.
Come on, bro. Let's go. All you're doing is you're just waiting to spew all your market analysis. But the chat wants this stuff.
They want to talk about Zoran Mamdani.
Yeah, that's what they're clamoring for. MTG, where are you? Yay or nay? Yay or nay? All right, S&P. I'm not going to get you in trouble. S&P 500 up 0.4%. Cash was at 61.41, but futures are nearing 6,200. God, I love that. I love everything about that. The Nasdaq up nearly 1%. The Dow Jones up 1%, and the Russell, they're hitting the like button like crazy right now. The Russell up. You guys are degenerates. I don't even have to. I could come in here and I could not even mention a single price for 90 minutes, and these guys would love all of it.
Should we do that Thursdays? I come on like once a month.
Mostly I do.
About markets at all.
Bro, when I'm alone, I might mention 3 prices in 90 minutes when I'm alone. When you guys aren't here, you guys are the only thing that anchors this show into the realm of trading. And then I'll come on here by myself and I'll talk about conspiracy theories for 90 minutes.
That's not on. Tom's overseas. Like
when the cat's away, the mice will play. None of them are watching my show. It's 5:00 at night. They're done. They've had a long day of work. I can talk about anything I want. I can do this. This could be like I've thought about doing like a Maury Povich show and just having a call-in and just doing like, are you the father type stuff. They would never know, bro. It would take them like a couple years to figure out what I've been doing with my 5:00 p.m. show. The Russell's up 1 2/3%. Christopher Vecchio, since you don't want to take a trust fall with me into more sensitive and vulnerable matters, I suppose we can talk about price action. 6,200 in the S&P, my friend. What say you?
I mean, I think it makes sense. Given some of the ideas that we've outlined here on this show and elsewhere on the network in recent weeks, that there is an inherent incentive structure built into the market for people to chase into the end of the quarter. This seems like it's kind of going according to that script. Just as a refresher, if that's a narrative that you haven't heard here before, I'm pretty sure I've said it a lot, but it's the idea that when you look at positioning in the market, particularly coming out of the first 2 weeks of April, the market, speculators, professionals are short. And on the way up, market's now 5% off its lows, 10% off its lows, 15% still short. And then you get through this period of wrong war in the Middle East, Iran.
It's all the same. It's all the same.
Yeah, I mean, like we're bombing people for oil again, I guess. So we find ourselves in a situation where every brick in the wall of worry has been there. We've scaled it. And if you're a trader, and this has been something you and I have talked about on camera for years, 22, 23, 24, losing money in 22, okay, everyone's struggling. It's a bear market. 23, it's a bull market. Okay, maybe you were flat-footed because of the war, Ukraine, Fed rate hikes, whatever. But in 2024, still being underinvested in stocks, it's going to lose your head. You can't underperform SPY if you're a professional trader, because then there's no reason to pay you and deal with the overhead costs and the insurance and all the other things that go into employing a person. You just buy the index otherwise. So there's been this incentive structure here built in because everyone was wrong. People kept shorting the market on its way up after the April 9th ceasefire announcement with Trump and the trade war. People had to chase. They capitulate. They close their positions. They ride long to paint the tape into the end of the quarter to say, yeah, we were underperforming, but we made it up. So am I surprised here? No. Trump today, CNBC headline, White House says that July 9th deadline is not critical. Of course it's not critical. You can't have a world. You can't have a world where China has lower tariff rates than your allies. That defeats the purpose of this whole reordering of global trade to get away from a system that has ultimately benefited China, that has allowed China to bootstrap our IP, Western Europe's IP, to build out their own competitors, to kick us out of their market, and then flood the global economy with cheap replacements overnight. Right? You can't incentivize people to produce in China, so you're not going to have a window where if there were no deals done, those countries are penalized and have higher tariff rates than China. So what's to worry about in the short term right now? People need to paint the tape. We're moving up. NDX is at a high. Triple Qs are at a new high. SPY briefly touched there today. We're waiting for the futures to arrive. All of that said, and I suppose a little bit more, low volume, low volatility, positive technical drift. It's that beautiful just buy the market and go fishing kind of environment. This market is also complacent. The volatility has fallen through a floor. The August 12th deadline is real. When Trump pushed back the tariffs against China in May, he did so explicitly because implementing them in the form and fashion that he wanted to would interfere with peak consumption season here in the United States, the Christmas holidays. But if he slaps those tariffs on in August and turns the screws on the trade war again, doesn't impact the peak consumption season. It's going to suck early next year if he falls through on it and doesn't taco out, which I pray that no one brings up to him again this time around. But that's when he could do it and get away with it without severely negatively impacting people's consumption habits, right, during the most important consumption period of the year. So I think right now I'm chasing this thing to the upside. My intention is to ride this up, and NASDAQ IVR is below 10, 21,500 puts. End of August seemed cheap to me, maybe even a long put spread that's out of the money. Take one of those 10% probability of profit trades, Victor, if you're a 9, and have some protection in your pocket if you're on the long side.
So you're saying synthetic. Basically, you're saying synthetic calls. You're long stock, and you're long downside puts. So effectively, you're synthetic long calls. Upside.
So right now in the Tasty Live account, I'm simply long call spreads in RTY and NQ. My intention is to layer longer dated, deeper out of the money puts that are relatively cheap right now on top of the shorter dated long call spreads, so that this window of, if I'm wrong on the short-term view, then because of how low volatility is and how cheap these options are priced, those will probably bump up enough to offset the losses in the long position. And if things really spill over, then those things will print. So I'm comfortable kind of talking out of both sides of my mouth here. Where I saw that headline yesterday, I brought it up twice on air today. Did you see that there's a company that's sending blockchain into space to help design AI-generated shoe designs?
Shoes? That's so embarrassing.
Yeah,
people say anything. This is like, remember when there was a period in time when all you had to do was put blockchain somewhere in your name or description, and that was good for like a lift in your stock. That's kind of where we are now. Just say something about AI in your business. To make any nonsense claim up, and it's good for a lift.
They had AI in there.
Bump in valuation.
They had blockchain in the announcement. They had SpaceX in the announcement.
Throw it all in.
All buzzwords.
I wish I could do something for my marriage. I wish I could just talk about AI, blockchain, space. I wish that would score me any points. It doesn't, though.
No, never.
Doesn't matter. I think I agree with the sentiment. I think what's most interesting about where we are now is that you can take very cheap upside bets. So even if you don't believe in the market, even if you don't like the valuations, even if you're long, like for me, I'm long, I can take off. If I want right now, I can take off long stock delta and replace it with very, very cheap upside call delta, which means I have ultimately much less capital at risk, and I can protect against a nasty little downside move. So I think we find ourselves in a really interesting period. You don't have to believe in the market necessarily. You don't have to love it. I don't love it, but I'm just taking what the market gives me. And if you're going to keep giving me super, super cheap volatility, well, then I'm going to figure out, all right, I'm running a long stock portfolio here. I could protect the downside of my portfolio with cheap vol. That's an option. I've done some of that. Or I can sort of replace some of my upside stock delta with just cheap call delta. 1650, man, in the VIX /VX, which is a front month volatility future contract at 18 and change. That thing doesn't seem to want to come much below 19. Your thoughts on vol here? I was talking about it with Mikey and Nick earlier. The at the money vol was like 11 to start the day, and they made the point that like the 1 day volatility from now until tomorrow was like 7.5% to start the day. So I mean, these things aren't moving at all, bro.
Why would they move though? I mean, what's catalyzing this market to do anything other than
float
drift
higher?
higher? Mm-hmm. Yeah, right. You don't see bear markets when there's no volume and low volatility. It's so stereotypical summer trading conditions, Victor. It's like, how did we get here, right? How after all of this we end up here where there's volatility falling off the falling out of the ceiling, falling out of the sky. That's what happened in 2017 and 2018, right? We were a little ginned up after the election, and okay, what's going to happen with Trump in office? And I remember, from like a business perspective, everyone's like, oh, this is going to bring a lot of volatility into the market. This is going to be really good for business. Because if you work in trading, right, the more interesting things happening, the more people trade. Mm-hmm. And yet 2017 and 2018 were total busts. So we've gone from a Trump that looked like he was world breaker in February, March, and the start of April, destroying trade alliances, ripping up trade agreements, and now he kind of looks like George W. Bush. When John Bolton is the cheerleader of your foreign policy efforts, I don't know if you're heading in the right direction. So that doesn't seem very Trumpian that John Bolton is the guy cheerleading those efforts. We're not having the tariffs. The tariffs aren't being implemented. July 9th is not a critical date. They're not doing Medicaid cuts either. The Senate parliamentarian ruled against it today, and Senate Leader John Thune has said that it wouldn't be good for the bill if the Senate parliamentarian ruled against it because they want to stay within the confines of what's allowed.
Of course, though, right? Bro. But that was always that so was going to be.
So what's changing, right? It's just there's a lot of bluster. There's a lot of tweets. It's shaping into a standard Republican administration again. And that was my take on Trump 1.0, which is if you remove the rhetoric and you look at what was actually accomplished.
You think this is a standard Republican administration?
It's certainly looking more and more like it, where it's like we talk about cutting deficits and debts, and instead we just cut taxes and right. And we talk about like no more foreign involvement, and we just bombed Iran, and maybe that was handled really well. And as time will go on, we'll see whether or not Iran can reconstitute its nuclear program. But right now, there's the bombs and missiles stop flying. Tel Aviv hasn't been hit in days, which I'm sure is delightful. Tehran hasn't been hit in several days, which I'm sure is delightful. And that's all well and good. But also Trump said NATO yesterday. He said, or actually this morning, it was a great, all caps, meeting, the best one we've ever had. So Trump's riding high right now, to be clear. Okay, the market responded positively, both in stocks and bonds after he backed off his tariff stuff. He still has people at the table negotiating with him, even if the negotiations aren't working out as fast as he wants. Japan's still at the table. India's still at the table, right? The EU today, headline floated, as was discussed at NATO, countries that spend more on defense, Trump will take a lighter approach with tariffs. Okay, so if you're him right now, why are you going to do anything other than keep along the current path? And if you're an equity market trader, I think we all agree on that. maybe it's the taco trade all over again that Trump's going to chicken out. I don't know if it's chickening out. I don't like that. I personally actually don't like that language. On the flip side, if I'm a Democrat, like, don't all of you oppose these policies?
Yeah, exactly. It's like, what do you want? What do you actually want? Do you want us to stay in World War III? Did you want the tariffs to stay on? Do you like the reverse psychology there is so odd to me.
No, it's so dumb. And that there's like a McKinsey consultant sitting around somewhere being like, this is the play, and they spend $20 million in that survey for them to figure out what to say about this. And the reality is, if you really oppose Trump's policies, you want him to chicken out. And so chiding him for being a chicken provokes him to not chicken out and then follow through on the things that you don't like. Who's doing these things? Who's thinking? Is anyone thinking through these? Okay, so I'm just like, really draw it out here for a second, folks. So, but NASDAQ up here, Trump's riding high. I'm waiting to see when he starts tweeting about the stock market. Remember in the first quarter, he was all, I don't care about the stock market. Something tells me that's going to change now that we're.
I don't know that he ever said that.
He said.
I think people around him said that. I don't remember him saying it.
No, Trump specifically said a few times, "I'm not looking at the stock market."
Maybe. I told you. I think we had a few Twitter exchanges. Like, I think people convinced him to go in that direction, but you can't teach an old dog new tricks. And he can try to pretend like he doesn't care about the market, but like, let's be honest, like that was his barometer for measuring his success throughout his first administration. There's no way he's going to come in and just go, I don't care if I tank markets by 60%. It's just like, there's no way you can just like flip a switch like that in a person who's 80 years old.
Oh no.
Let me ask you this: bonds at 115. We keep floating higher. I mentioned this earlier today. I think I first caught this from a guy named Jeff Snyder, who made a really good point that like there's call skew throughout the curve, and I was like, what? And I went and checked it, and there it is: the 2s, 5s, 10s, and 30s. At least this morning, my morning when I looked, I think right before the market opened, there is call skew across the entirety of the curve. In other words, people are traders. The option markets are making tons of upside bets relative to downside bets here at these prices. To me, I think that makes a lot of sense. I'm also long. I'm also making upside bets. What say you? It's been a super boring trade. There's 100 other things, more interesting things, more higher volatility things to talk about right now. But I'm sort of obligated to give a couple of minutes to bonds here. What say you about the upside in bonds here?
I think bonds are following the path that one might expect if, again, like a thesis of ours here and elsewhere on the network has been that bonds would perform well with a recalcitrant Fed that refuses to heed Trump's calls for cuts, right? And the framework for that is simply just looking to what happened in September of last year when the Fed cut by 50. So they lower rates, and what happens? Stocks rip, bond yields churn higher, the dollar screams to the upside. It's a reflation trade. And when we say reflation, right, think of it like a fire, okay? The fire's burning, and the Fed adds cuts, fuel, to that fire. So the market says, okay, we have to price in higher growth, higher inflation again, and financial assets go up in value. The opposite side of that would be if the Fed people are thinking like, okay, should the Fed cut? We want the Fed to cut, and they don't. Well, by not cutting, they're reducing fuel. They're not adding fuel to a fire, and a fire that then diminishes. Growth expectations and inflation expectations slowly come in. And so the fact that the Fed's been holding steady here for a few weeks, we've moved away from the tariff craze. The bond market looks like it's a market that's behaving very normally again. It's moving slowly because these are small adjustments. If the bond market's going to have a sustainable rally, it can't do it in leaps and bounds. It needs to kind of edge up there little by little by little. And so I think that's actually very constructive right now. I know that's a view that Ilya has as well. But to that point, I think the question is, what's the trade here with a 13.7 IVR and sitting near 115? This isn't the hottest place to get in long right now because we have bumped up against this 115 level a few times over the past 6 weeks and have failed to crack through it. You get through 115, you start to look into the 117s or so. I understand on a risk to reward basis, people say, you know what, I'm going to get short here. I'm going to do a short 115, 116 call spread. And, as long as we stay close below 115, I'm going to hold it because of the risk to reward. You're up against resistance. As for me, my positions right now, I have long call spreads and short put spreads on here in ZB. They've been going on for a few weeks. The long call spreads do need to be rolled because there's 29 days to expiration. And when I have out of the money calls that aren't quite there yet, I prefer to roll at 28 days than 21. But beyond that, I'm going to remain constructive here. I think the Fed is going to hold in July as the market's price, but I don't think what these Fed speakers are saying, quite frankly, in the short term is about the actual cut. It's more about their job security and maybe seeking a promotion of Fed chair by President Trump. And so to that point, July's not happening. Powell this week said the inflation comes June, July, August, which is him effectively laying out that they will have enough information by September to make a decision. So, yeah, I think that we're going to get, right now as things stand, asterisk, we're going to get a September cut.
I think so too. I
say asterisk. Yeah, go ahead.
Well, I was just going to say, I think you're right too. I think we're going to have dissent in the July meeting.
Yes.
I don't know that they'll be ready to actually cut in July, though I do think the opening will be there. I think there will be dissent, to your point, and I think they ultimately do it in September. But I agree with everything you said. But what I keep looking at is this new piece of paper that the Federal Reserve put out in front of everybody the other day. At Fed funds rate at the end of 2026 at 3.6% at the end of the year. Meanwhile, the market's like, you're a big fat liar. You're going to be at 3 to 3.25 by the end of 2026. So there's this gap, there's this spread that's starting to open up between where the market is and where the Fed is. Now the market, we've done this every year for like the last 3 years. The market puts in the market puts in what it wants to see, and then ultimately is proven wrong. They're proven too dovish, too early. And I'm curious, Chris, how are you thinking about this spread that's opening up between a Federal Reserve that says we'll be at 3.6 at the end of 26 and a market that's going, no way, liar, liar, pants on fire, you're going to be at 3 to 3.25. What do you think about that spread that's opening up here? Is the market doing the same exact thing it's been doing with wishful thinking, or is the Fed trying to pretend like it doesn't see cracks in the housing market, like it doesn't see softening in the labor market, like it doesn't see softening in some of the economic data? Are they trying to play this Mr. Magoo as long as possible, but ultimately it's going to mean that they're going to need to play some catch up here? What would you bet?
I think the market has it right insofar as the Federal Reserve isn't an institution that likes to skate to where the puck's going to be. They're very reactionary, and they're frequently fighting the last war. And so in 2020, when they had a chance to lower interest rates, what was on their mind? What happened in the global financial crisis? The problem with the global financial crisis was that not enough help arrived soon enough. And you see this in the markets themselves, where Congress or the Fed is doing something and the markets go, well, this isn't enough. This isn't going to solve the problem, right? You're just giving us a bucket to scoop water out of the boat. Meanwhile, the holes are still letting water in. Okay, thanks for a bigger bucket, I guess. And so when the pandemic came around, the Fed said, no. We're not going to drip drab this out. We're going to let everyone know up front that we're willing to do whatever it takes, throw the kitchen sink at it. And so when inflation was coming back in post-pandemic, what were we hearing from Fed officials? Let's change average inflation targeting. We had a period before the pandemic where inflation was undershooting. And so let's make up for it. They were fighting the last battle, and they let rates stay too low for too long, which is to say now today's battle is dealing with COVID's memory. And COVID's memory was that the Fed kept rates too low for too long, and they weren't responsive enough. And so there's this inflation boogeyman that's sitting in the room, and the 800-pound gorilla in the room, that if the Fed starts to cut now and they're wrong about inflation, then they risk much bigger problems down the line. And that's to say that the market cares more about the Fed's inflation mandate than its unemployment mandate. The Fed misses on its unemployment mandate, the market's like, okay, so you're going to cut. But you miss on the inflation mandate, it means you're going to raise rates. Most likely. It means cost of capital is going up, right? Businesses don't want that. They penalize the Fed, spreads widen out. We don't know if policymakers actually have a grip or handle on the situation. So there's a game here that's being played. I personally don't think it's political, right? The tariffs are obviously adding to this. no doubt in my mind that the tariffs are preventing the Fed from cutting. But the Fed isn't not cutting because they want to make life more difficult for Trump or don't want to give in to Trump. It's because they're legitimately worried that if they cut too soon, they're going to pour fuel onto an economy that is stronger than most people thought it would be by this point in time. How many recession calls have there been over the past few years? Okay. Right now, the Fed's best decision is to sit on its hands, because if it loses credibility, and I would know some people would argue it lost credibility by giving 50 basis points of cut in September. But if it were to lose more credibility then, because it acts too soon, then you have really bad situation in bonds, in stocks. And we don't need that kind of craziness in a bond market where we've already had these smells of fiscal irresponsibility coming through and you know, putting that kind of strain on the long end of the curve, like there's some sort of crisis going on.
I tend to agree with you. I think the way that I would explain it is just like, if they cut and the long end lifts again, they're totally effed.
They're screwed. Yeah.
They're screwed, because they basically, you now admit to the world, you have very little tools to do anything. You are sort of held in bondage to the market, and you just have to sit there and look at everything. Your only option is to raise rates, which they clearly don't want to do. So you can move forward guidance or whatever, but you're going to lose credibility to move forward guidance once the market sees that you cut and the long end lifts again. So I think they're in this really weird spot, man, where like they have to wait until they kind of see the whites of the eyes of growth starting to deteriorate, until they see a meaningful uptick in unemployment. Unless they want, like, it's weird, because I said in the middle of last year, I said cuts are the new hikes. And what I meant by that is, I thought at that time, if they cut, the long end would lift, and that would actually put more pressure on the housing market, slows the economy even more so. So in a weird way, the hotter the economy is, the more you would want to cut, which would lift the long end and kill. It would dampen even more economic activity. It's sort of this inversion of what people are expecting. Like, to me, I think we're still in this world that cuts are the new hikes until you start to see growth meaningfully rolling over. But at that point, it's like, are they already too late? And I think that's what the market's starting to price in, that we're going to play this drag your feet game because they're terrified of doing the same thing that happened in last September. So they've got to see the rollover, but once they see the rollover, they have to act quick in order to make sure that growth doesn't just fall off a cliff, or unemployment doesn't fall off a cliff. And I think that's the game that we're in right now. We're just waiting for them to find that sweet spot so that they can start cutting without the long end lifting. I think that's what we're watching right now.
And you know what? The market thinks that Powell's the problem. You can see how more cuts have been added to next year, the second half of next year, more than any other time. And it's because the second half of next year is Trump's new Fed chair. And so I think there's a well understood idea that whoever Trump nominates is going to cut rates, or at least try to steer the FOMC in the direction of cutting rates. Because the FOMC itself is a board. It doesn't operate under the diction of one person, right? And so, like,
it has under Powell. Powell's had some weird voodoo where there's been very little dissent under Powell. But just because you nominate a dove to the Fed chair, to your point, it doesn't mean they have to keep moving like a fist.
They don't need to. And there's also a part of me that thinks there could be kind of like almost like how the body responds, like a white blood cell reaction, where these Fed officials see someone who is not one of them installed. And so, like, they just kind of, like, the Fed chair can say what he wants, but everyone else on the board is going to vote in solidarity in one direction. And if the Fed chair happens to be in agreement with them, fine, they're all on the same page. And if the Fed chair wants to do his own thing, he doesn't have the votes to change policy. So, I mean, there's also part of it.
Polymarket has Chris Waller at 36% probability of being the next Fed chair. The next closest is Hassett at 19.7, with Kevin Warsh at 19.7 as well.
Kevin Warsh and Waller, Christopher Waller, are two legitimate candidates, and the Fed would be in excellent hands with either.
Hassett would be It would be crazy.
I'm moving out of the country if Kevin Hassett's Fed chair. Okay, I can't put that on camera. I would have a dramatically different approach to how I trade and operate in markets if Kevin Hassett were Fed chair.
Yeah. What's his name? Besson only has 14% chance. How wild would that be? Hassett, he's an automatic rubber stamp. You know, he's sort of this quiet architect of sort of the whole Trump economic policy.
Is he? Every time I hear him speak, I see Trump contradict him like 5 minutes later. It's like he's watching. It's like he's watching Hassett on Fox News and be like, "No, that's wrong. Gonna have to tweet something out of." During the whole all of April, there were several headlines. I'd be more than happy to provide citations after this, but we had several Futures Power Hour episodes in early April where it's like Kevin Hassett says this, and then like under it was a Truth Social post 30 minutes later. Where it's like we're not backing off the tariffs, and Hassett's been on with like Maria Bartiromo being like, yeah, the tariff rates are going to come down, and Trump's all caps, they're never coming down.
I know, but that's his thing, though.
I know it is. It's just like that's also the bark. That's also the bark and the bite of all of this. Yeah. And I actually think, and I shared this with Nick Batista a few days ago. I can't get the thought out of my head that the bombing of Iran's nuclear facilities did more to push forth any potential trade deals than anything Trump has done thus far through the cycle.
Credible deterrence.
Not just credible deterrence. I think this is a big stick. Also, we've been showing the world for the last 2 years. And like as someone who is a proponent of us being involved in the war in Ukraine, send them more bombs, give them as many weapons as they need. No American boots on the ground, but this whole idea of like what we're actually doing, where we're allocating money for Ukraine, we're taking the corresponding old inventory out, shipping them all the old weapons, then we're using the money that we just allocated to replenish our stock with newer bombs, newer weapons, right? I think that's a good trade-off. We're also defanging and running down the army of Russia, which I'm always against the loss of human life, but like if Russia wants to try to invade one of its neighbors, historically speaking, we know how that works out. And so I think that we should knuckle down in the name of, decency and liberal democracy everywhere. So defanging Russia, good. Okay, they can't defeat Ukraine? Wait, it's the Russian army versus Ukraine with American and European weapons. Okay, but Iran is the big scary one. They have their tentacles through the Middle East, Hezbollah, Hamas, and yet they can't defend their homeland. American bombers can sneak in. Aren't these supposed to be like the tips of the spear for BRICS? These are supposed to be the people that are like making BRICS seem viable. There's a military alliance. Yeah, China's lurking in the corner, but China and India aren't going to get along. So now all of a sudden, after the past week, really after October 7th, okay, Russia can't topple Ukraine, okay? Iran, a country that has 92 million people, as I learned watching a Tucker Carlson interview recently, that has 10 times the population of Israel. Israel just, Khomeini's so tied up he can't respond to direct messages. BRICS are a joke. And so if you are someone who's in Italy or Latin America and you're looking at alternatives to the world, you go, I can stick with the US, or I can join this hodgepodge group of people who are trying to challenge the US. And oh, by the way, in these conflicts they just had, like they're not really doing what they say they can do. It's kind of like a running joke with some of these militaries in the Middle East. They're really good at producing videos with bombs and scary sounding music. And then like they're also really good at dying. Because when they actually
I had no idea you were a military hawk. Were you always this hawkish?
I'm pro-empire.
You sound like a psychopath right now.
I'm pro-empire. No, I just think that BRICS.
You sound like an absolute sociopath right now.
No, I'm very pro-America, and I think the people who have been pitching this idea that there's an alternative system out there relative to the Western world got a real reality call this past week.
I don't think so.
They've been getting a reality call since February 22.
I think you're right that there wasn't this big show of force. Like
me being pro-America and you talking about MTG earlier, I'm the psycho. Okay, go on.
Bro, you think equating those is wild.
I think
equating those two things. Saying MTG is mildly attractive and you talking about bombing everybody on the planet and nobody stepping up to defend these other countries, which means we're still showing our imperialist might. Those are nowhere close to the same things.
pro-empire, just like Teddy Roosevelt was pro-empire. I am pro-empire.
I would say I think we have a very short-term point of view on these things, and I think we're playing against opponents who are taking a long game. And if you're taking a long game, I do agree with you that there is one short-term point of view, which is, hey, look, if Russia or China is supposed to be your deterrent or your bully, your champion on your side, where are they? They're not there to step up for you. I also think we did a ton of damage to our own reputation on the world stage. And I don't think China doesn't move on hard military power. Yeah. They are acquiring soft power throughout the world. And the more we impose I'm pro-America just as much as the next guy. I'm just saying, if you think about this for the long game, there is a way to think about this where, yes, some other military power did not oppose us. But the question is, did we help or hurt ourselves on the world stage? On some aspects, we might have helped ourselves. In some aspects, we might hurt ourselves.
I don't, given public polling, okay, so how do we determine how we are perceived on the world stage? I think that's an important benchmark, right? When a politician says we've never been more respected on the world stage, according to who? Okay, so according to public polling, the U.S. has never been less respected on the world stage right now, and that has nothing to do with the bombing in Iran, because polling from our allies' countries in recent days about the bombing in Iran, people support it. People around Western Europe support us bombing Iran because they're within the radius of some of these ballistic missiles. And if you attach a nuclear warhead to it, you could have an Iranian bomb land in Berlin at some point in the future. Do they like having one fewer country that could nuke them in their,
Bro,
area?
How are you falling for this stuff? Why are you falling for this? The same rhetoric in 2000, they're going to do this to you. Do you understand? They're going to do this to you until you die, bro. Until you die, they're going to tell you that there's some big scary person who's developing some big scary weapons, and we need to go in and kill everybody.
What did I say last week? I'm against the war, okay? But when you look at polling, what I think, again, America's standing on the stage, what we just did in Iran this week and probably improved our standing on the stage with the people whose opinion we care about, right? Like, do we care if the Chinese think that this eroded our standing on the global stage? No, but in terms of our allies and partners who we're trying to strike trade deals with, and then we have a really good NATO meeting that Trump is calling great and the best ever. And yeah, you know what? We can be lenient on the tariffs if you guys bump up your military spending. This all seems very this is the most kumbaya I've seen Trump with other world leaders in either the first or second presidency so far.
I think all those things are true. I wouldn't disagree with anything you just said. I still think this is the same playbook that they ran in 2003, and I don't know. I just that scary tactic just doesn't do anything for me anymore.
No,
hey,
and
these guys,
these
guys are scary. We need to go kill them all. It just doesn't do anything for me.
There's what's the common joke from people who served in the military? Well, it was the Cat Williams joke, right? Like, what's an Iraqi army uniform look like? Does anyone know? Does anyone know what like an Iranian army uniform looks like?
I remember that special.
Right? Because it's like we're not over there killing soldiers. We're just over there killing people. Okay? I get that.
We're gonna lose all of our viewers. We're gonna get canceled today. We started off the show talking about comments. We're 100% getting canceled, Christopher.
We
happen to be here. Your eyes were doing the talking. Your eyebrows were talking. My mouth was talking.
The tears coming out of my face. The sweat on my palms.
Okay.
I didn't know the nape of my neck could sweat like that.
Let's get canceled. What'd you think about New York's Democratic primary?
I'll be speaking about this in about 15 or 20 minutes time at a Democratic Party meeting. So I'll say the same thing there that I'm going to say here. I think there's
no way you're going to be at a meeting in 15 minutes. The show gets over in 10. How do you get there? What do you have? Is the meeting at your house?
It's like 3 minutes away.
Fair enough.
I live in a walkable town. Regardless of the policies.
I bet when you leave your house, you kind of live in one of these communities where you don't put the G on morning. Like when you walk down the street, you go
Yeah, I'm walking around my
paper.
slippers.
Morning.
My robe on. Morning, neighbor. No, I live in like the woods up a hill. Okay.
So
my neighbors are
I
bobcats
guarantee you
and-
don't put the G. I guarantee you don't put the G on morning. And I guarantee, you probably get the paper. You go out, you get your mail in the morning. You probably
I'm
wear
like
a robe,
Eddie
some
Griffin in
slippers.
Undercover Brother. I enunciate every word and letter.
All right, what'd you think about the New York Democratic primary?
I think we talked last week, and I said that, if Cuomo lost, he probably wouldn't run again, but Mamdani, pronounced it correct this time, would continue to move forward. And Cuomo did drop out after losing the way that he did.
Mm-hmm.
I've seen a lot of people kick around the narrative that, it was only wealthy people that voted for Mamdani, and it was New York's working class, the working poor that supported Cuomo. And like, they know better, right? That's disingenuous, okay? And I think we need to dig deeper into the actual income data. And as it turns out, when you look from post to post, the way that the New York Times and others define these things, you make more than $50K and less than $100K in New York City in any given year. That doesn't mean you're middle income, right? That's not New York City, okay? You have to go further out. And so when you look at the actual breakdown of votes by district and by income decile, Mamdani won the majority of people making more than $55,000 a year and making less than $150K a year. That is the middle class. Now, why did he win the middle class? He focused on affordability. What about affordability? Childcare, housing, transportation. Why did that work with the middle class and didn't say appeal to the wealthier voters, people who make more than $150,000 a year, and people making less than $50,000 a year? There is the idea of the dual income trap in a certain sense. And when you look at household formation in America, middle income households are more likely to have two parents working than either wealthy or poor households, which then conceptualizes and actually helps frame the affordability situation a little bit better. If you're really wealthy, you're not worried about childcare. You're not worried about public transportation, and you're certainly not worried about housing. So a candidate who runs on that platform doesn't speak to any of the things that bother you in your life. And if you're in the working poor, and not just data, but I have my own anecdata, having tutored in New York City public schools for 8 years after work for kids in kindergarten through third grade, teaching them how to read. And I sat on the board of a children's charity, helping facilitate that work. There's one working parent in the household, the other parent doesn't speak English. And that's why they need the reading help. But that's the situation. It's a one single parent working household, and so they don't need the child care. And if you have a one single parent working household where you don't need that second income, you're actually not worried about your housing affordability either as much. And so you have this split in the breakdown right now where you can see middle income people, two income households vote for Mamdani, and everyone else is voting for Cuomo. And that brings me to my big point here, which is to say that April 14th, 1938, FDR's fireside chat, people, it's not that they don't love democracy, it's not that they don't love our economy and way of life, but if the system that we have right now, that people are buying into, that you're told if you do things the right way, you go to college, you take out the student debt, you'll be able to get a home and have a family, and you do all those things, and you don't have any savings, and you're crushed by debt, and you're not married, and you're in your 30s, and you go, this system doesn't work for me at all. I'm willing to give anything else a chance. And so when centrist Democrats run someone, a sex pest like Andrew Cuomo out there, who I have my own personal grievances with for various financial reasons, for money that was taken away explicitly because of his resignation from office, I can't help but say, like, you guys did this to yourself. You guys chose someone who is disliked, who kills grandmas during COVID, who propped up an independent caucus to prevent Democrats from having a trifecta for a number of years. If you don't want unorthodox candidates like a Trump or Mamdani or an AOC to win these elections, be effective in the center. Deliver on things, get the trains running on time, pick up the trash, make sure the schools are safe, the police are well funded, that the police have good relationships with their community so there are no shootings or violence, right? Like, do the things necessary. And then you don't have to worry about people thinking, well, I'm willing to try government-run grocery stores, which also, Victor, how many states have government-run grocery stores in this country? 14? How many of them are states that have Republican governors and Republican majorities? 11? So why are people dunking on Mamdani? This is the president of the United States has a veto in U.S. Steel now. That's way more communist than opening up 5 grocery stores, 1 in each borough. So there's a lot of pearl clutching right now. I know the whole global intifada phrase, we discussed it last week, it gets under my skin. But this was not a policy election. This was a generation change election. 24% of people who voted in the election yesterday and early voting were newly registered voters. In the last mayor's race, that was like 4%. Okay? So the idea here is if you don't like who's winning these elections, find a message that resonates with people, that speaks to the concerns in their lives, and get out there and talk and go on podcasts, go on, do interviews. Don't just hide in your basement and pop up for a debate where then everyone realizes, oh my gosh, Joe Biden's 82. He looks it.
Let's go 2 different paths here. We only got a few more minutes, but let's go 2 different paths. Just because I'm curious. Path number 1 is let's go down 2 different paths of how effective Mamdani's policies could be. So let's go down one path where it becomes very, very difficult to deliver for the New York mayor. It becomes very difficult if, let's say, he goes on to win the actual general. The idea that he's unable to bring some of these policies to life, and that ultimately he's making a lot of promises that politically become very difficult to deliver on. So take us down that path. The likelihood that he's able to deliver on a lot of these big promises, the rent freezes, the city-run grocery stores, and the litany of other very new to NYC policy promises he's made. And let's go down a different path, the other path, which is he's able to implement all these things, and whether or not these things actually fix the core problem. Does it actually address inequality in your mind, or does it potentially exacerbate it? In other words, the argument against the rent freezes is that as soon as you minimize the profit motive, you minimize the desire to maintain properties, to continually invest in them because you've limited the upside in some of these things. So do you actually create better or worse living conditions for people? So let's go down 2 paths. The first path is he wins the general and he's unable, the likelihood that he's unable to implement a lot of these big promises. And the other path is let's imagine the happy path. He's able to implement these things so they actually make people's lives better at the end of his term. What do you think, man?
So, yeah, the 3 paths in my mind are he tries all these things, they all fail. He ends up like Brian Johnson in Chicago, where he keeps pushing them on and they keep failing. There's a path where he tries to do all these things and they're super successful, but we don't really have a blueprint for that because America hasn't had a socialist mayor since Milwaukee in 1960. So it really hasn't been tried. There was a woman who won in Buffalo a few years ago, India Walton, who won the Democratic primary as a Democratic socialist. And then the mayor, Byron, I can't remember his name right now. He did a write-in campaign, even though he was the Democrat who lost, and he won re-election as the sitting mayor. So there's talk of, I know Eric Adams is here doing this, that, the other thing, but let's focus on the world where, well, this is one of the reasons why I reject this framework in my head. The one thing, I don't live in New York City, so I don't have to vote for any of these people. But the one thing that intrigues me about Mamdani's approach is that he seems pragmatic in the sense that, having listened to his interviews recently about economic policy, and again, I'm skating past his affiliation with SJP or
yeah.
Right.
Sure.
We got to disaggregate this stuff. He was asked when talking with the Abundance guys, Derek Thompson, Ezra Klein, they have their book. He was asked, what if you do these things and they don't work? And he said, well, I'm not wedded to the idea, I'm wedded to the outcome. Right? Like I think this idea will produce the outcome that I hope it will. But ultimately the goal is to get the outcome. And so if these things don't work, I'll try something else. And quite frankly, I think that's refreshing to a lot of people. You don't hear any other candidate talk about things like that. They have their things. I got to do this because that's the special interest group that supports me. And if I don't do things that way, I'm going to lose their support, and I need their support. And we need more politicians who are like, I'm just here to solve problems, man. And if the best problem is a supply side oriented solution, Let's do that. Hell, Zoran's best video from the campaign was that halal one, right? And when he got to the end of the video about why halal prices are $8 or $10 instead of $8, it's all about regulations with the city. It's all about the fact that the city doesn't issue enough licenses and has too many requirements for licensing, and a small group of private citizens charge like $20,000 for a food truck license when the city sells them for $400. But the city doesn't let these licenses out. So it's a small group of people who control them in the private sector, and they charge an arm and a leg. So how do you make up for that as a food cart vendor? You have to increase prices on your food to pay off the permitting. Okay, so if you reduce permitting costs, what happens to the food prices? They go down. So that's a supply side solution. He seems to embrace that, right? I think that's what all of us want. I personally, I've never called myself any ism. I want, and I think you do too, we want better outcomes in the world. And if there's a solution that gets us there, if it involves more government, involves less government, we should try it. We shouldn't be wedded to like government has to be involved or it can't be involved. There are places where it works and there are places where it doesn't, and there's a balance. And let's experiment and find what works. But let's stop living with these problems. And Andrew Cuomo, by the way, what could be more stereotypical of the person who helps create these problems? A former governor who did what? What did he accomplish? He helped create this. He upheld the system that is failing so many people. Why would you give that guy another chance?
What was the guy? What was the mayor's name? What was the mayor's name during COVID? What was his name?
De Blasio.
What was the guy? Yeah, De Blasio. I just every time I go back to when you remember when he ate that Five Guys burger? I think it was Five Guys, and he tried to encourage people to get the vax, to get the jab. And you got a free like cheeseburger if you got the jab. And there's this clip of him. It still floats around the internet today. And he's just taking a bite out of this burger. He goes, "You mean to tell me if I get the jab, I get this delicious 2 beef patties?" It's like one of the most condescending things. It's like it perfectly marks that COVID era. I don't think I'm down. I don't have to live in that city. I'm down. If the people want to try new things, let's try new things.
Please don't be Brandon Johnson. Please don't be Chicago's mayor.
I don't think it's going to work. I don't think this is what you want. I think a lot of people are so disillusioned with the outcomes of the last 15 or 20 years. They believe somehow everyone has it in their mind. It is capitalism's fault. And to me, it's the opposite of capitalism. We do not have competition. We do not have a functioning government. Money, after Citizens United, has too big of a sway in our government. We socialize the losses and we allow private entities to privatize the gains. We're so far away from what like real functioning capitalism looks like. And I feel because people are so angry at the idea of capitalism, which we don't have, they're willing to try quote unquote new things, which is moving in a very, very socialist direction. And look, man, I'm not going to knock it. My personal opinion is you're going to unlock a new set of problems that you don't want either. And I think by being unwilling to sit down and really think critically about these problems and think critically about what these set of solutions will then create later on, it sounds good. Sounds good to say don't move rent forever. Sounds good to say let's put the government in control of the food supply.
Rent freeze is a pro-landlord policy.
Yeah, bro. I just think we don't.
I'm anti-landlord as like on the city level. Like you don't want landlords to have power. When landlords have power, they mistreat their tenants. Yeah. Okay, so you dilute the power of landlords by building more housing.
Yeah, boom, man, boom. And it's like nobody's saying that part. Somehow people keep coming in and they promise the wrong stuff.
His plan was like, well, we're going to build 200,000 units over the next decade. Everyone's like, oh. It's like, well, okay, well, how many units did you? It's like that's actually a slower run rate for what we've been doing. That's not something to cheer.
Yeah.
I gotta go, Victor. I can't. I'm gonna have an aneurysm.
All right. Good luck at your meeting, man. If the people want more from you, tell them where they can go.
At CVecchioFX on Twitter or X. How do you feel about Elon these days?
I'm kind of neutral. I think I haven't heard much about him. I don't think he's
Follow me
talking
on
much
Zitter.
crazy stuff.
Follow me on Zitter at CVECUFX. Here on the network Monday through Friday, Futures Power Hour, 1 p.m. Eastern. Let Me Explain Tuesday mornings, 9:40 a.m. Eastern with Tom and Tony. Victor on Wednesdays, 6 p.m. Eastern. And then, of course, Overtime with Radigan and Spivak, 4 p.m. Eastern.
If you want to follow me on Twitter, you can follow me at Victor Jones, Owen Jones 0, because I like to be difficult. This is Synthetic Friday here. Normally, Chris, on Thursdays, I do a little lip sync at the end of the show. But because you're here, I'm going to let you take us out. What song would you like the producers to play while you lip sync?
Bye, bye, bye. Right? We're leaving.
All right, everybody. We'll see you next week. Same time, same place, same great network on Tasty Live. Thanks. Peace.